Please like, share, and subscribe. Wishing you happiness and good luck every day.
All right, today we're cracking open a real classic, Andrew Tobias's The Only Investment Guide You'll Ever Need. And look, this isn't about chasing hot stock tips. Actually, we're going to see pretty quickly why that's a terrible idea. Instead, what we're going to do is boil down the book's core wisdom, which you'll see is all about getting your mindset right, not getting lost in complicated strategies.
Okay, let's dive right in with a story from the book. A bit of a cautionary tale, really. It just perfectly sets the stage for why chasing those get-rich-quick promises is so dangerous.
I mean, have you ever gotten a hot tip? Come on, you know you have. We've all been there, right? A friend, some expert on TV, an article that pops up online, and it's promising these incredible can't-miss returns. It's so tempting, and that's exactly where this story kicks off. So picture this. You're reading this investment guide, and you get to a section about Mexican savings banks. The author, who seems like a total expert, tells you that you can earn a whopping 12% on your money. I mean, at the time, that was more than double the 5.5% you could get back home in the US. Sounds pretty amazing, right?
Now, your first thought might be, wait, what about the currency risk? And yeah, that's a thing. But the guide tackles this head-on. It reassures you, pointing out that the peso has been locked to the dollar for 21 years. It even calls it one of the stablest currencies in the world. It really feels like this expert has all the bases covered. So what do? You do it! You trust the guy, you're sick of those tiny returns, and just like the book says, you take L plunge. You wire your savings over, already dreaming about that sweet, sweet 12% interest just rolling in.
And for a bit, everything's going great. You're feeling like a genius. And then, bam! Out of nowhere, the Mexican government decides to float the peso. That means they're just going to let the market figure out what it's worth. Suddenly, that 21-year history of stability, poof, gone. Overnight, the currency just tanks by 40%.
You're absolutely gutted, but you tell yourself, okay, don't panic, don't sell at the bottom. That's the classic advice, right? So you hold on, hoping, praying for a recovery. But then, just 6 weeks later, it happens again. The peso gets floated a second time, and the value drops even more. So what's the final tally from following that one can't-miss tip? Your investment is now down 52%. Yep, more than half of your money, just gone. It's a brutal, but man, what a powerful lesson. Okay, so that painful story, it's not just a sad anecdote. It actually reveals one of the book's biggest ideas. That whole peso disaster, it wasn't just bad luck. It was a classic case of failing to see the big picture, what Tobias calls the forest, because you were so focused on one very, very attractive tree. And this quote right here, this is really the heart of the whole philosophy. It's not about being a genius who finds the perfect stock or the perfect bond. It's about understanding the entire economic world you're operating in. If you get the forest right, the individual trees pretty much take care of themselves. So, okay, what is this forest he's talking about? Well, the book argues it really boils down to two huge, overarching forces that basically shape everything for every investor: the national debt and where interest rates are headed. Just to give you a feel for this, back in 1980, the U.S. national debt was only about 30% of the entire economy. That gave the country a ton of wiggle room to borrow if a crisis hit. Fast forward to 2016, and that number has shot past 100%. That massive safety net, it's pretty much gone, and that changes the entire game for investors. And here's the other piece of the puzzle, and it's a huge one. Back in 1981, you could literally lend the government $1,000 and get $336 in totally risk-free interest over 2 years. Think about that. By 2016, that exact same loan would get you $20. For decades, falling interest rates were like this massive tailwind pushing all investors forward. Now, that wind has died down.
All right, so if this big picture stuff is so complicated with debt and interest rates and all that, does that mean you have to become some kind of expert economist to have any chance? Well, you might be surprised, but the book's answer is a very clear, very loud no.
You know, this is one of the weirdest, most counterintuitive things about finance. In almost any other part of life, sports, your job, learning an instrument, the more you study and practice, the better you get. But with investing, Tobias makes this incredible point that trying harder and learning more can actually end up hurting you. And this is where that famous analogy comes in, the one about a monkey throwing darts at a stock page and doing just as well as the pros. It's famous for a reason, because it's kinda true. Study after study shows that the huge majority of highly paid professional money managers just can't beat a simple market average over the long haul. To really hammer this point home, Tobias tells this great story from when he was at Harvard Business School. The professor gives the class this case study with just a mountain of data and asks them to run all these super complex calculations to figure out the perfect price for a company's sprockets.
So when the professor calls on Tobias, he basically admits he didn't do any of the math. He just points out that the case itself said it was a competitive industry and the company was already selling every single sprocket it could make. So, duh. They couldn't charge more than the competition and there was absolutely no reason to charge less. The market had already set the price. No calculations needed.
And guess what? That was the right answer. The professor's whole point was to get the class to spend hours getting lost in these complex formulas, only to reveal at the end that all that detailed work was completely irrelevant. Tobias saw the forest, not the trees, and he solved the whole thing in an instant.
Okay, so let's recap. If chasing hot tips is a trap and trying to become an expert is basically a waste of time, what on earth are you supposed to do? Well, the book lays out a really simple, really sensible path forward.
It really just comes down to this simple idea. Stop trying to play games that you are basically designed to lose. Seriously, instead of hunting for the next genius investment, just focus on not making the common, costly mistakes that trip everyone else up. Keep your eye on your own financial picture, your savings, your debts, and stop stressing about picking the perfect stock.
And I love how brutally efficient this way of thinking is. The book will take these huge, complex worlds, like commodities trading, and just dismiss them in a single sentence. And why? Because the data shows that 90% of the people who play that game get burned. For Tobias, that's it. That's all you need to know. Game over. Move on. So this all comes together into a really clear, actionable path. Step 1, just dismiss anything that smells like a get-rich-quick scheme. Just walk away. Step 2, focus on the big picture context, not the day-to-day noise from the market. And step 3, keep your approach dead simple, because the more complicated a strategy is, the more ways there are for it to blow up in your face.
And we're going to end on this really powerful quote from Calvin Coolidge that's a big theme in the book. After all this talk about stocks and bonds and currencies, maybe the most important financial wisdom has nothing to do with investing at all. It's about the simple, but not always easy discipline of just living within your means. That really is the foundation for everything else.
All right, let's talk about something. Why is it that most of those investment books you see, the ones promising to make you rich, well, they probably won't? We're going to get into it.
I mean, that's a pretty wild claim, isn't it? It's like the author is telling you, hey, I'm the expert here, but this book, it's not the magic wand you're hoping for. And that little paradox, that right there is the key to understanding a massive trap in the world of personal finance.
Okay, so let's set the scene here. Picture this. You've just picked up one of those hot new investment guides. You know the type, something with a catchy title like Dollars and Cents. You're at home, flipping through the pages, you're getting pumped up, just hunting for that one big idea.
And of course, the pages are just littered with exclamation points. So you're skimming past chapters on antique cars, gold, mutual funds, and then you find it. A chapter all about Mexican savings banks.
And boom, there it is, the hook, 12%. I mean, the power of that number alone is just incredible. It's more than double what you could ever hope to get at home. The book even gives you this little wink, mentioning that Mexican banks don't report interest to the IRS. It feels like you've just been given the secret handshake into the club for smart money. And when you look at the numbers, the difference is just staggering. Over 20 years, your money doesn't just grow, it explodes. That $1,000 you started with, it's on its way to becoming almost 10 grand. Suddenly, the other option looks, well, kind of pathetic, right? The hook is definitely set. Now, obviously, your brain kicks in. There's a risk, right? What if the peso gets devalued? Your whole nest egg could just shrink. But the expert, the author, he just kind of waves it all away. He tells you, don't worry, the peso is one of the most stable currencies in the world. It's been fixed to the dollar for over 20 years. The government promised not to devalue. And just like that, you feel a whole lot better.
So what do? You trust the expert. I mean, the stock market is scary. This whole thing seems so simple and safe. And hey, the guy wrote a book. He's got to know what he's talking about, right? So you convert your dollars and you take the plunge.
And for a little while, it really did seem like the perfect plan. Until, well, it wasn't.
For a solid 18 months, everything is just perfect. You are an investing genius. Seriously,
While all your friends are getting excited about the free clock radio they got for opening a savings account, you're just casually mentioning your high-yield peso notes at dinner parties. You feel absolutely brilliant.
And then, September 1976 rolls around. Mexico announces the peso will now float. What does that mean? Well, within days it plummets 40%. Whammo, just gone. And then, after a tiny little pause, it floats again. And now, in just 6 short weeks, your investment has been cut by more than half.
And here's the crazy part. You weren't alone. Not even close. Americans lost somewhere between $6 to $8 billion on this supposedly stable investment. It was a massive, widespread financial disaster, all built on one very seductive, very simple promise.
And the source material for this story? It ends the chapter with this absolute gut punch of a question. The very book that led you down this path asks, with just dripping irony, aren't you glad you bought that book?
Okay, so this story isn't really just about the peso, right? What it really does is pull back the curtain on a fundamental flaw in how we think about investment advice and the so-called experts who dish it out. This quote just absolutely nails it. You get these experts who can drown you in details. They can tell you the exact number of railroad ties between New York and Chicago, but they completely miss the one thing that actually matters, knowing when to sell. It's a perfect example of how knowledge is not the same thing as wisdom. In fact, this leads to that famous idea, backed by studies, that a monkey throwing darts at a stock page can often pick a portfolio that performs just as well as one managed by some highly paid professional. It's humbling, and let's be honest, kind of hilarious, but that's the reality of the market. And this is where it gets really weird. It's the most counterintuitive part of all this. With most things in life, like learning to cook or playing chess, the more you practice and study, the better you get. But with investing, trying harder, learning more, can actually work against you. It's what leads you down these dangerous rabbit holes, just like the Mexican peso.
So, if getting lost in all those details, the trees, is the trap, how do you avoid it? Well, you have to learn to see the whole forest. Okay, so the author tells this amazing story from his time at Harvard Business School. The whole class gets this super complicated case. Their job? Calculate the perfect price for a company's sprockets using all these formulas. When the professor calls on him, he admits, yeah, I didn't do all the complex math. Instead, he just used some simple, big-picture logic. He basically said, look, the market's competitive, so they can't charge more than everyone else, and they already have all the business they can handle, so there's no reason to charge less. The answer? Just charge the same as the competition. And that simple forest-level insight, that was the entire point of the ridiculously complex case. He solved it in like 30 seconds, and the professor basically had to dismiss the class right then and there. And this forest thinking leads to a really powerful strategy. Sometimes the easiest way to win is to just not play the games you're probably going to lose. So the author just starts crossing entire categories off the list. Commodities? Nope. Over 90% of people lose their shirts. Collectibles like stamps or art, you're up against real experts and the fees are insane. Basically, the rule of thumb is this. If it's some complicated scheme and the person pitching it is really enthusiastic, you should probably just turn around and walk away. So what makes these games so dangerous? The author calls it the trappings. You know what I mean? It's the exciting story, the slick sales pitch, that feeling of complexity that makes you feel smart, like you're in on something. All those trappings are just there to hide the fact that the odds are, well, they're terrible. And that really leaves us with one last powerful question to think about. If you strip away all that fancy wrapping, a lot of these so-called investments are really no different than walking into a casino and putting all your money on a single number on the roulette wheel. So it really makes you wonder, why would you ever play a game you're almost guaranteed to lose?
All right, let's dive in. Today, we're going to take a classic piece of financial advice, something we all think we know, and flip it completely on its head. We're going to see why, in our modern world, a penny saved is actually 2 pennies earned.
You know this one, right? Of course you do. A penny saved is a penny earned. It's practically financial gospel, straight from Benjamin Franklin himself. It feels solid, timeless. I mean, it just makes sense. But what if I told you that in today's world, good old Ben was actually off by 100%? Yeah, see, the world's changed just a little bit since the 1700s, and the biggest game changer for our wallets is something he never really had to worry about: income tax. So, it's time for an upgrade. We're going to explore a new financial rule for the 21st century. And it's simple. A penny saved is 2 pennies earned. I know, it sounds a little crazy, but stick with me. By the end of this, you'll see this isn't just a catchy phrase. It is a powerful financial truth.
So how on earth do we get from 1 penny all the way to 2? Well, it all comes down to understanding how your taxes actually work. So let's pull back the curtain and look at the math behind this magic. The key, the absolute linchpin to this whole idea is your marginal tax rate. Now, this is super important. This is not your average tax rate. It's the slice of tax taken from the very next dollar you earn. You know how our tax system is progressive? Well, this is the rate you pay at the top end of your income. And it's the number that really matters for pretty much every financial choice you make.
Okay, so to make the math here crystal clear, let's just use a nice, simple, round number. We're going to imagine your combined federal, state, and maybe even local marginal tax rate all adds up to 50%. And hey, for a lot of people, especially if you live in a higher tax city or state, this number isn't as wild as you might think.
So let's put this 50% rate into action. Let's say you want to have an extra $40 in your pocket, maybe for a nice dinner out. If you decide you're going to earn that money, let's say you get a small bonus at work, you'd actually have to get $80 before the government takes its cut. Let me show you what I mean.
And boom, here it is. This slide lays it all out. To earn that extra $40, you have to go out and make $80. Why? Because in our 50% bracket, half of it, $40, goes straight to taxes. That leaves you with the $40 you wanted in the first place. But what about saving $40? Well, you just don't spend $40. That's it. There's no tax on money you decide not to spend. So by simply skipping a purchase, you get the exact same result with half the effort. Saving is literally twice as effective as earning. Okay, now that you've got the core concept, let's see how this plays out in the real world. Because this isn't just some theory for your paycheck. This principle applies to your everyday life. You can actually think of smart shopping as a kind of investment, one that pays out guaranteed tax-free returns right there in the grocery aisle.
Check out this great story about Charles Revson, the founder of the cosmetics giant Revlon. This guy was a business tycoon who apparently lost a ton of money in the stock market. But you know where he got some of his best returns? On mouthwash. Seriously, he'd buy his favorite brand, Cepacol, by the case. By doing that, he got a huge bulk discount and he hedged against future price increases. That simple move gave him a 20 to 30% annual return. And guess what? It was completely tax-free.
Let's run the numbers on another example, maybe something a little more fun. Let's say your household enjoys about one $10 bottle of wine a week. Your local shop offers a 10% discount if you buy a case of 12, so you spend $108 up front instead of $10 each week. Over the course of the year, you save $52. By tying up that little bit of extra cash, you've earned a staggering 53% tax-free return on that money. Are you kidding me? You cannot find that in the stock market, and definitely not risk-free. Okay, I think you're getting the picture. So now, let's make this really actionable. Let's do a lightning round of some of the biggest impact saving strategies you can use, pulled right from the Frugal Playbook. First up, the undisputed heavyweight champion of tax-free returns, crushing high-interest debt. When you pay off a credit card that's charging you 18% interest, that is the exact same thing as earning an 18% return on your investment. It is guaranteed, it is risk-free, and it is tax-free. Frankly, it's financial malpractice to have money sitting in a savings account earning 1% while you're paying out 18% on a credit card balance.
Next up, the car. For most of us, this is just a giant money pit. I love this line. The new car smell is the most expensive fragrance in the world. It's so true. Buying a good used car, picking an economical model, and selling your old car yourself instead of just trading it in, these moves can save you thousands and thousands of dollars. And please remember, leasing is almost always the most expensive way to have a car.
Now let's talk insurance. Here's the secret. You should only pay for protection against catastrophic risks, the things you truly cannot afford to cover yourself. So choose the highest deductible you can comfortably afford to pay out of pocket. That one change will lower your premiums, and over a lifetime, you'll almost certainly come out way ahead. And always, always buy term life insurance, not whole life. You get so much more coverage for your money, and just skip all the little stuff like those silly appliance warranties.
So, we've covered the logic, and we've gone through the tactics. Now for the really fun part, the part that is honestly just mind-blowing. Let's look at the incredible results of putting all this together over time. We're going to see how tiny, seemingly insignificant changes can build truly massive wealth.
Let's start with something super small, something you might not even think about, a daily habit. Maybe it's a fancy coffee, maybe it's a soda from the vending machine. Let's just call it $5.
$5 doesn't sound like much, does it? But let's do the math. $5 a day, 5 days a week, for all 52 weeks in a year. That adds up to $1,300. And here is where we bring it all home. To have that $1,300 available to spend on coffee, if you're in that high tax bracket we talked about, you would have needed to get a raise of about $2,000. That's what you have to earn to fund that little habit. But to save it, you just have to not spend it. See how powerful that is?
And this right here, this is the grand finale. What happens if, instead of spending that $5 a day, you invest it? Over a 40-year career, earning a pretty reasonable return, you end up with almost $800,000 in today's money. All of that just from redirecting one small daily expense. It's incredible.
Look, at the end of the day, this isn't about being cheap or depriving yourself of joy. It's about being intentional. It's about understanding the true power of your money and realizing that every single dollar you don't spend is way more powerful than a dollar you go out and earn. So I'm going to leave you with this question to chew on. What one small, insignificant expense in your life could you redirect to totally change your financial future?
You know, a lot of us spend so much time worrying about money, but very few of us actually take that time to sit down and make a real, sensible plan. Well, today, we're going to change that. We are going to walk through a super clear, practical guide that'll help you turn all that financial worry into an actual, actionable plan for your life. It's time to take control. And believe me, it all starts with just a simple shift in how you look at things.
And let's be real. Sometimes it absolutely feels this way, doesn't it? I love this Ogden Nash quote because it just perfectly nails that frustration. It can seriously feel like saving money is this impossible task, but we're here to show you that it's not only possible, it's actually way more manageable than you think.
The entire process really just boils down to these three basic questions. This is the foundation for any good financial plan. First, you've got to know your starting point. Then, you need to define where you're headed. And finally, you build the map that's going to get you from here to there. So, our first step is all about making that move from just worrying to actually having a plan. We're shifting out of that vague, kind of unproductive anxiety and into the clear, focused state of having a roadmap. This is such a crucial first move, especially if you've ever felt like you're just spinning your wheels, trying to make ends meet. And this is so important to get. We're not just talking about pinching pennies or feeling guilty about every coffee you buy. Nope. What you're going to end up with is a full-on plan that empowers you to direct your finances, to set your own priorities, and ultimately to take the driver's seat in your own life. Okay, so with that mindset, it is time to figure out your financial position. This really means answering those first two questions. Where am I right now, and where do I want to be? And to do that, you're going to need a really clear snapshot of your financial health today. And that snapshot, it has a name. It's your net worth. It is the single most important number for understanding where you stand right now. It's really simple. You just add up the value of everything you own, we call those your assets, and then subtract the total of everything you owe, your debts. So the crucial first step is to get this all down on paper. Make 2 columns. In one, list what you own, the value of your house, your car, your savings. In the other, list what you owe, your mortgage, car loan, any credit card balances. Then you do the math, assets minus debts. That number you end up with, that's your net worth. That's your financial starting line. So once you know where you are, you can finally decide where you want to go. Your budget is really just the tool you build to reach these goals. So be specific and give yourself a deadline. Maybe in 1 year, you want to be completely out of credit card debt. In 2 years, you want to have $5,000 in a retirement account. And hey, maybe in 5 years, you want to have built a net worth of $60,000. Now, these tips are absolutely key to making this work. Writing goals down makes them feel real. But notice the advice here. Don't make them too aggressive. You want to aim for goals you secretly believe you can blow past. Why? Because that builds momentum and makes you feel great. And your biggest, wildest dreams? Well, as you can see, think of those as the icing on the cake, not the foundation of your whole plan. Okay, we've got our starting point and our destination. So the next logical step is to map out your money flow. This is where we get into the nitty-gritty and track the 2 most important things, what's coming in and what's going out. The very first step is to figure out your annual income. That's your take-home pay after all the taxes and deductions. And here is a fantastic piece of advice. Always estimate low. Why? Because that way any surprises, like a little bonus or some extra income, are pleasant ones that put you ahead of your plan, not behind it. Now for the expenses. I just love this analogy from the source material. Trying to list out all of your spending categories is a lot like trying to name all 50 US states from memory. It sounds easy, but it's way trickier than you'd think. You'll get the big expenses right away. No problem. Rent, car payment, you got it. But just like you might totally forget about Nebraska, you'll probably miss some of those smaller categories, like gasoline or gifts or lawn care. But don't worry about it. Just pull out last year's bank and credit card statements. They're like the perfect map to help you find every single one. So, you've mapped your income, your expenses, and your goals. Now comes the really important part, juggling your plan. This is the decision-making phase where we make it all fit together. This is the million-dollar question, right? Once you add up all your estimated expenses and your savings goals for the year, how does that grand total compare to your income? Ideally, you're bringing in more than you plan to spend and save. But let's be honest, a lot of the time, there's a gap. If you find there's a shortfall, you basically have three main options. First, you can spend less by trimming your budget, but you have to be realistic about it. Second, you can try to earn more, maybe with a side gig. And third, you can adjust your goals and just make them a little less aggressive for now. It's all about finding the right balance between these three choices. And this is just brilliant because it shows you the real power of this whole exercise. Going back and forth, juggling those three options, it isn't just about making the numbers add up on a spreadsheet. The process itself forces you to figure out what's truly important to you. It helps you set your life's priorities and then consciously aim your finances in that direction. And that leads us perfectly to the ultimate goal here, taking control. Because this was never just about numbers. Once you have a plan that truly lines up with your priorities, the psychological payoff is just enormous. This is the huge mental shift. Without a plan, skipping a dinner out just feels like a depressing sacrifice. But with a plan, it's totally transformed. You're not passing something up because you can't afford it. You're choosing to pass it up because you want to, because your eye is on a bigger, more important goal. And let me tell you, that feeling is incredibly satisfying. Now, if all this talk of tracking and spreadsheets makes you cringe, the source offers this beautifully simple alternative, the don't touch it budget. The idea is you build the discipline right in from the start. You automatically send 20% of every single paycheck into savings or investment accounts that you never ever touch. Then you just live on what's left. It might sound a little unconventional, but for a lot of people, it's way more effective than tracking every last penny. In the end, it really all comes down to this timeless piece of wisdom from Charles Dickens. The secret to financial happiness isn't really about how much money you make. It's about the relationship between what you earn and what you spend. Living just a little bit beneath your means, that is the fundamental path to security and, well, peace of mind. So I'll leave you with this final thought. A plan doesn't mean a thing until you actually internalize it and take action. And it doesn't have to be some massive overhaul overnight. So what is one small, totally manageable change you can make today to start building that little bit of space between your income and your spending? Because that small change, that's the first step toward taking control.
You know, when it comes to your money, there's a simple, maybe kind of brutal piece of advice that can save you a world of trouble, and it's this: trust no one. Today we're going to dig into why the single most important financial advisor you'll ever have is you.
I love this quote. It just perfectly captures what we're talking about. This isn't about being paranoid or cynical. It's just about being smart. Sure, listen to people, be open to ideas, but at the end of the day, you have to be the one to verify the deal for yourself. You got to cut the cards.
Oh, I bet you do. They were all over TV for years. You had these familiar, friendly faces, guys like Dick Van Dyke or Gavin MacLeod. Yep, Captain Stubbing from The Love Boat, looking right at you through the screen, offering you peace of mind. Let's start right there.
I mean, the pitch was just fantastic. A celebrity you feel like you know is offering your family $10,000 in big dollar protection. And the price? Get this, just $5 a month. So you have to ask, what's the catch?
And here it is, the core promise. And it was a huge selling point, especially for older folks who might have some health problems. Guaranteed acceptance. No physical exam, no nosy questions. It just felt so safe, so simple, and it was all backed by a face you trusted. But now, it's our turn to cut the cards.
So here's catch number one. That full $10,000 payout, it was only for accidental death. If you died from an illness, which for people over 45 is how people die over 97% of the time, your family only got about $2,800. All of a sudden, that big dollar protection is looking, well, a whole lot smaller.
Oh, and it gets worse. Even that tiny payout wasn't a sure thing right away. If you died from an illness within the first 2 years of having the policy, your family got nothing. Well, actually, scratch that. They got a refund of the premiums you'd paid. That's not a safety net, my friends. That's basically a savings account with a terrible interest rate. Now, this next one is a real masterpiece of fine print. They guaranteed your monthly payment would never go up, but they never said anything about your benefit amount. As you got older, your coverage just nosedived. So get this. If you signed up at 50, paid in for 25 years, and then died at 75, after you've paid in $1,500, your family would get a check for just $225. Wow.
And what about that accidental death part? Well, their definition of accident was, let's say, pretty narrow. The policy wouldn't pay out if the death was from hang gliding, being in a private plane, suicide, or even if it happened during surgery. The list of things they wouldn't cover was frankly huge.
Right. And that big promise that your rates would never go up, yep, that had a catch too. The company couldn't single you out for a rate hike, but they absolutely reserved the right to raise rates for everybody in the plan, or even just cancel all the policies if it wasn't making them enough money. So much for a guarantee, right? And finally, that $5 price, that was really just the hook. It was the absolute lowest price to get you in the door. Most people were then encouraged to sign up for much bigger plans, some costing around $40 a month. Now, for a lot of older folks on a fixed income, that's almost $500 a year for a policy that was just full of holes.
So there you have it. That's the gap between the promise and the reality. The headline screamed about a safety net worth thousands of dollars, but the fine print whispered about a payout that might only be a couple $100. It's just a classic reminder that the headline is never, ever the whole story. Okay, so maybe we know we can't trust a paid celebrity pitch man. That's fair. But what about a group of, down-to-earth, seemingly brilliant amateur investors? Let's talk about the world-famous Beardstown ladies.
I mean, these women became global superstars. They wrote best-selling books, they were all over TV, and it was all based on their incredible investing success. They were living proof that any regular person could beat Wall Street at its own game. So, let's cut the cards on their performance, shall we?
Okay, so their advertised annual return was a mind-blowing 23.4%. But when an auditor finally looked at the books, they found a huge math error. Their actual return was only 9.1%. And during that exact same time, the stock market in general returned over 15%. So they weren't financial wizards, they were actually doing worse than a simple, boring index fund.
All right, so now we're wary of celebrities and we're skeptical of self-proclaimed gurus. But surely we can trust the experts at a super prestigious place like the U.S. Trust Company, right? Let's take a look at an oil and gas deal they were recommending to their very wealthy clients. So this is how the bank actually described the investment. The language is so calm, so reassuring, very professional. You see words like quality, moderate risk, significant upside. It sounds like a totally solid, expert-approved opportunity.
But on page 1, the very first page of the official legal document, was this warning, in all caps no less. It's a direct contradiction to the bank's soothing sales pitch. One says moderate risk, the other screams high degree of risk. So, which is it? And the deception went even deeper. The glossy sales brochure claimed past programs had returned 127% of the cash put in. Sounds great, but this was based on a totally misleading calculation. It gave equal weight to one tiny, incredibly successful program way back in 1973. When you actually looked at all the money invested over the years, the real return was just 45%, meaning investors had lost more than half their money. And here's the kicker. The trusted expert, that prestigious bank you're paying for top-tier advice, they hadn't even done the basic homework. Their independent analysis was just a copy and paste job from the marketing brochure. They took the sales pitch at face value instead of cutting the cards and reading the actual documents.
And this is the question all of this leads to, isn't it? We've just seen how friendly faces, famous experts, and elite institutions can all lead you down the wrong path, whether they mean to or not. It kind of leaves you wondering, where do you even turn?
The answer is blunt, I know, but it's also the beginning of taking back control. You simply cannot blindly rely on anyone else to have your best interest at heart, but that doesn't mean you're on your own.
See, this isn't a burden, it's just reality. And honestly, taking ownership of your financial life is the single most powerful thing you can do. It means you're in the driver's seat. You can still use experts for their expertise, but you make the final call. Always.
So what does this actually look like day to day? Well, it's really about following a few simple, core ideas. First, you take responsibility. Second, you just refuse to invest in anything you can't explain to someone else in simple terms. You stick to things that are easy to understand. You diversify so you're protected if one thing goes wrong. And yeah, you can hire accountants or advisors, but you see them as helpers, not as the final decision makers, because you are always the CEO of your own money. At the end of the day, it really all boils down to this one question. The world is just filled with shiny, alluring headlines, from celebrity promises to expert predictions. But the real story, the one that truly, actually impacts your financial future, it's almost always buried in the details. So the question is, are you taking the time to read them?
All right, let's talk about something that might sound a little weird. When it comes to your money, being a coward can actually be a brilliant move. Today, I want to make the case for being cautious, for playing it safe, especially when you're just starting out, because that right there is the first real step to building wealth.
You got to hear this old Wall Street joke. So, a broker keeps losing his client's money year after year on terrible stock picks. The client finally calls him up, totally fed up, and says, "You know what? Maybe I'd just be better off in bonds." And the broker says, "Yeah, sure, but what do I know about bonds?" It's funny because it kind of hits close to home, right? The world of finance can feel so confusing, and sometimes it feels like even the experts are just guessing.
So, how do we even start to navigate this world? Well, let's begin not with a stock, but with a horse race. The author of our source material tells this great story about the one and only time he went to the track, and it perfectly nails this tempting, dangerous idea of speculation.
So picture this. He's at the track, and he knows absolutely nothing about horses. Zero. He's there with a buddy who's a total pro, a guy who's been going twice a week since 1959. This friend knows everything, the jockeys, the stats, the track conditions. Our author? He's just getter kind of bored and wants to get in on the action. So his friend lays out the super logical case for the favorite, the horse that's almost guaranteed to win. But our guy, he just ignores all that solid advice. He scans the list and picks a horse named Willow. His expert friend just scoffs. I mean, Willow had never even been in a race before. She had absolutely nothing going for her. So why in the world did he pick her? The author just said, "You're missing the point. Willow is going off at 25-1. See, it wasn't about the horse at all. It was about the thrill of those crazy long shot odds. This was a classic sucker's bet. But you know what? He placed it anyway." And then the unbelievable happens. The race starts, and Willow, this total unknown, she takes the lead. He's on his feet, shouting, "Come on, Willow." And she doesn't fade, she doesn't stumble, she wins. At 25-1, the long shot actually comes through. So you think the lesson here is obvious, right? Forget the experts, trust your gut, and always go for the huge payoff. But that is not the point of the story. In fact, it's the exact opposite. Now here's the kicker. The author only bet $3. And he says he knows this in his gut that if he had put his whole $100 on the line, an amount that actually mattered to him, there is no way on earth Willow would have won. When the stakes are real, when it's money you can't afford to lose, the universe of speculation has a funny way of knocking you down. And that right there brings us to the whole point of this explainer. This idea that being cautious, even a little chicken-hearted with your money, isn't a weakness at all. It's about understanding a really basic rule of how the financial world works. Seriously, let this one sink in, because it might be one of the most important things you ever hear about investing. The financial markets are incredibly efficient. That means there are no free lunches, no easy bargains just lying around. If a deal looks way too good to be true, promising massive returns with zero risk, you can bet it's a trap. If you're careful, you get a fair return. If you get greedy, you get burned. And this brilliantly illustrates the point.
This is the only graph in the whole book this comes from, and it tells you everything you need to know. On one axis, you've got the return you're hoping for. On the other, the chance you'll lose your money. And what's the relationship? It's a straight line. The higher the potential reward, the higher the risk. Always. Every single time. There's no escaping it. Think that's just a theory? Okay, check out this real-world story. The author was once offered a sure thing, a stock in a company called Nationwide Nursing Centers. He could buy it for $8 a share when it was trading for $22. And the story was that it was about to be bought out for $40 a share in just 3 months. Sounds amazing, right? A total gift? Well, the stock went to 0 in less than a year. Even the surest things can be a fast track to losing it all. Okay, so if we're going to be prudent, we have to understand the absolute basics. All the super complicated financial products out there, they all boil down to just 2 fundamental types of money. It's really this simple: debt and equity. Think of debt as an IOU. You are lending your money to someone, a government, a bank, a company. So things like bonds, CDs, even your savings account, they're all in this bucket. It's safer because they promise to pay you back, usually with some interest. Equity, on the other hand, is owning a piece of the action. You're investing your money, buying a small part of a company, like a stock. There are no promises here, but if the company does great, you can do great. It's definitely riskier, but the potential for growth is so much higher. All right, so before you even think about taking on the risk of owning a piece of the action, there are some crucial first steps. And let me be really clear. Following this advice does not make you a sap. It makes you incredibly smart. So here's the deal. Until you have paid off your high-interest debt, we're talking credit cards here, and built up a solid foundation of, say, $10,000 to $20,000, it is just not wise to mess with riskier investments. And that money needs to be kept someplace completely safe where you can get to it easily. Think a savings account, a checking account, maybe a money market fund. This is your emergency fund. This is your bedrock. You do not gamble with it. Okay, so once that foundation is rock solid, then you can start looking at ways to earn a little more on your safe money. This is what we're calling the coward's investment menu. And the most important idea to get your head around here, especially with bonds, is the interest rate seesaw.
It's a really simple but powerful relationship. Just picture a seesaw. Okay, so when the general interest rates across the whole economy go up, the price of existing bonds, which are stuck paying that older, lower interest rate, goes down. I mean, it makes sense, right? Why would anyone pay full price for your old bond that pays 5% when they can just go out and buy a brand new one that pays 7%? It's a seesaw. Rates go up, old bond prices go down. And, of course, the reverse is true, too.
And believe me, this isn't just some minor little wiggle. Interest rates can swing wildly. Just look at this chart. The prime interest rate was a little over 3% back in 1955, but by 1981, it had skyrocketed to almost 19%. This is exactly why that seesaw effect is so powerful and so critical for any bond investor to get.
So, where can a cautious investor put their money? Let's start with what's basically considered the safest investment on the planet: U.S. Treasury bills, or T-bills. Think of these as short-term loans you're making to the U.S. government. The key feature here is just unparalleled safety. You will get your money back, period. Another fantastic tool for a prudent investor is something called a TIPS. That stands for Treasury Inflation Protected Security. These are special government bonds, and they're designed to solve a huge problem for safe money: inflation. With the TIPS, the bond's actual value goes up with inflation, which means your safe money doesn't slowly lose its buying power over the years. And all of this brings us to our final and maybe our most important idea. We've spent all this time talking about avoiding risk, but now we need to really redefine what the real risk actually is. Because here's the thing, the biggest financial risk you face in your lifetime isn't losing some money on a speculative bet. The biggest risk is that you won't save up enough money for the big stuff, for emergencies, for college, and especially for retirement. After you factor in taxes and inflation, it is pretty much impossible to build real long-term wealth from safe investments alone. So being a coward with your foundation, that's smart. But being too cowardly with your long-term growth money, well, that's taking on the silent, certain risk that you'll simply run out of time. So the real question is, how do you balance being prudent today with being prepared for tomorrow?
All right, let's get right into it. You know, for most of us, taxes feel like, well, a penalty, right? It's this chunk of our hard-earned money that just vanishes. But what if we could flip that script? What if taxes could actually be a tool, a powerful tool for building wealth. That's what we're going to dig into today, using some really smart strategies from our source material.
I just love this quote from the source. It's such a clever way of putting it, right? Taxes are just a fact of life if you're earning a living. But hey, just because we have to pay them doesn't mean we can't be smart about it. So let's talk about how.
So here's the big problem, the main villain of our story today. If you don't have a strategy, taxes are just a massive drag on your investments. Think about it. Every single dollar you pay in taxes on your gains is a dollar that's no longer out there working for you, compounding and making more money. And yeah, this thing has a name, tax drag. It's like trying to run a race with a parachute strapped to your back. It's this silent force that's constantly slowing you down on your path to building wealth. It's basically the gap between what your investments say they earned and what you actually get to keep in your pocket.
And just look at this chart. That difference is stark, isn't it? That tall blue bar, that's your potential. That's what could be. But the shorter gray bar, that's your reality once tax drag gets its hands on it. Now, over a few years, that gap is noticeable. Over decades, it's a life-changing amount of money. Our whole goal today is to shrink that gap as much as we possibly can.
So, are you ready to fight back? Ready to keep more of your own money? Good. Let's get into the actual strategies. And we're going to start with something that's on a lot of people's minds, saving for the next generation.
All right, part 1. Let's talk about giving your kids a massive financial head start and doing it in the most tax-smart way you can.
Okay, so what's with this number, $11,700? Well, according to our source, that's about how much extra money you could have after 18 years just by saving in your kids' names instead of your own. How does that work? It's simple, really. A kid's first chunk of investment income is taxed at their super low rate, or not at all. You're basically letting the money grow in a much, much friendlier tax environment.
But what about saving specifically for college? For that, we have even better purpose-built tools. So, what are the best accounts out there? Our source material really focuses on 2 main players. On one side, you've got the Coverdell ESA, which stands for Education Savings Account, and on the other, the super popular 529 plan. Now, both are awesome because they let your money grow completely tax-free for education, but they have some really key differences. The ESA has a lower contribution limit, just $2,000 a year, but you can invest in pretty much anything. The 529, on the other hand, lets you put in way more money, but you're usually stuck with a limited menu of investment choices.
So the big question is, which one do you pick? Well, the author's tip here is crystal clear. It's like a 1-2 punch. First, you hit the ESA. Put your first $2,000 of college savings in there every year. Why? For that investment flexibility. Then for any savings above that $2,000, you funnel it into a 529 plan. It's a simple and seriously effective strategy.
All right, let's shift gears. Now we're moving on to part 2, powering up your own retirement. And I'm not exaggerating when I say this. For most of us, this is the single most powerful weapon we have in our arsenal to fight taxes and build real wealth.
And when it comes to your 401k at work, especially one with a company match, the author does not pull any punches. I mean, come on, an employer match isn't just a good return, it's literally free money. Think about it, it's a 50 or even 100% return on your money instantly, before it even has a single day to grow. Passing that up is, without a doubt, one of the biggest financial blunders you can make.
Okay, to really see the power of tax-sheltered growth, check out this example from our source. Let's imagine you invest a single lump sum of $5,500, and then you just let it ride for about 40 years. So if you put that money in a normal taxable brokerage account where taxes are chipping away at it year after year, you'd end up with around $51,000. Hey, not bad, right? But just wait. Now, what happens if you put that exact same $5,500 into a tax-deferred IRA where it's shielded from taxes that whole time? It balloons to over $182,000. That's more than 3 times the money. No extra risk, no extra work. That, my friends, is the magic of compounding, when you take tax drag out of the equation.
Okay, so you're on board with the IRA. Awesome. But now you hit the big choice, traditional or Roth. Honestly, it all comes down to one simple question. Do you want a tax break now or do you want it later? With a traditional IRA, you get a tax deduction today, but you'll pay taxes when you take the money out in retirement. With a Roth, it's the opposite. You pay the tax now on the way in, and then every single penny you withdraw in retirement is 100% tax-free, for good.
So which one's the winner? The author makes a really compelling case for the Roth IRA, and here's why. First, it gives you way more certainty. The money you see in your account is actually the money you get to keep, No future tax bomb waiting for you. It's also more flexible. You're not forced to start taking money out at a certain age. And kind of cleverly, since you're putting in after-tax dollars, it's like you're sneaking more tax-advantaged money into your retirement savings. For most people, most of the time, the Roth is absolutely the way to go.
Okay, now before we get to the big finale, our source material has a quick but really important warning. It's about a product you've probably seen advertised as a great tax solution: annuities. And the author's advice on using these things for tax-deferred growth? It's about as direct as it gets. Just avoid them, flat out. While they sound good on paper, they often come with some serious downsides that just don't stack up against the other options we've talked about.
And here are the big reasons to be super cautious. First, they're notorious for having high fees and commissions that just devour your returns. Second, and this is a big one, they have this weird tax problem where they turn your beautiful, low-tax capital gains into high-tax ordinary income when you pull the money out, total opposite of what you want. And finally, your money is often locked in with these massive surrender charges if you need it early. So, after all these strategies, all these numbers and warnings, what's the one big thing you should walk away with? It all boils down to one simple but unbelievably powerful idea: the power of time. And this story from the source just illustrates it perfectly. Get this. Picture a 12-year-old, right? They have a little side job and they earn $1,000 a year. They take that $1,000 and put it into a Roth IRA, and they only do it for 10 years. So by the time they're 22, they've put in a total of $10,000. And then they stop. They never add another penny. They just let that 10 grand sit there and grow completely tax-free inside the Roth. So what's it worth when they turn 70? $1.5 million tax-free. No, that is not a typo. That is the jaw-dropping, almost unbelievable power of long-term tax-free compounding when you give it the single most important ingredient it needs: an early start.
And that really brings us to the final big idea here. We spend so much energy trying to earn more money, find that perfect stock, or time the market just right. But based on everything we've seen, maybe we're asking the wrong questions. What if the most powerful financial tool you have isn't money at all, but time?
All right, welcome. So you've done the hard part. You're a great saver, you've built up a solid financial base. But now you're asking that big question, okay, what's next? Well, today, we're going to dive into the world of stock market investing. And our goal is to help you go from being a good saver to a really smart investor. You know, this Mark Twain quote just hits the nail on the head, right? It perfectly captures that anxiety so many of us feel. It's like the stock market is this dangerous game where no matter when you start, you feel like you're doing it wrong. But what if there's a way to approach it without all that fear? Let's break it down. So if you're nodding along right now, you are in exactly the right spot. You've done all the responsible stuff, you've put in the hard work, and now you've got some money on the sidelines wondering what to do. This explainer is built specifically for you, to give you a clear, common-sense roadmap for putting that money to work. Okay, so before we jump into the how-to, we gotta talk about the why. I mean, with all the scary headlines we see, why should you even consider putting your hard-earned money into stocks? Well, the case for it is actually incredibly compelling.
It really all boils down to three huge reasons. Stocks can help protect your money from getting eaten alive by inflation. They've historically delivered some really amazing long-term growth, and they come with some pretty sweet tax advantages. Let's dig into each one.
All right, first up, let's talk about inflation. That cash you've got stashed in a savings account, well, every single year it buys a little bit less. But here's a cool way to think about it. A company that sells, say, bread can just raise the price of bread along with inflation. That helps their profits grow, and that in turn can help the value of your stock grow. It's a built-in defense mechanism. Now for that second point, long-term returns, let's take a little trip back in time. Between 1926 and 2015, the absolute safest bet out there, U.S. Treasury bills, they gave you back about 3.7% a year on average. I mean, it's not nothing, but it's barely keeping your head above water with inflation. Okay, so what if you were willing to take on just a little more risk with corporate bonds? Well, during that same time frame, you would have seen an average of 5.9% a year. Okay, getting warmer, right? But oh man, this is where it gets really good. So what about the big guys, the stable, blue chip stocks? They returned on average 9.8% a year. And bad gap, that's the market's way of saying, thank you for taking on some smart, calculated risk over the long haul. And if you're thinking, A few percentage points, what's the big deal? Well, look at this chart. This right here is the absolute magic of compounding. Over that long stretch, your $1,000 in T-bills turns into maybe 20 grand. In bonds, it's over 100 grand. But in stocks, that same $1,000 grows to a whopping $2.5 million. I mean, come on. That is why we're talking about this.
And last but not least, let's talk taxes. See, with something like a bond, you get hit with taxes on the interest every single year. But with stocks, that growth, all that value building up, you don't pay a dime in taxes on it until the day you actually sell. It's like your money gets to grow in a tax-protected bubble, which is just a massive boost over time.
Okay, so the upside is pretty amazing, right? But let's be real. That 9.8% return is not a smooth, straight line up. It's a roller coaster with some serious stomach-churning drops. And to be a successful investor, you have to understand that emotional ride. And here's something you absolutely have to burn into your brain. Market crashes are not a mistake. They're a feature. They are going to happen. It's just part of the deal. I mean, just look at the history here. The Great Depression, the 70s crash, the dot-com bust, the 2008 financial crisis. These massive drops are a normal, expected part of the landscape. So that raises a really interesting question, right? We all know what fear and panic look like in the market. But what about the other side? What happens when everyone is just giddy? When your neighbor, your cousin, and every expert on TV thinks stocks can only go up?
Well, this table tells that story perfectly. Back in the early 70s, you had these stocks everyone loved. They call them the Nifty 50. The thinking was these were one-decision stocks. You just buy them and you're set for life. But just look at the carnage that followed. Polaroid, the Apple of its day, down 91%. Walt Disney, down 86%. This is a classic case of hype completely running away from reality. So, at the end of the day, you have to see the market for what it is, a giant pendulum swinging back and forth between greed and fear. When everyone's greedy, prices get way too high. When everyone's fearful, that's when you find the bargains. And the secret isn't trying to guess where the pendulum is going next. It's about keeping your own emotions in check while it swings.
All right, so we get the why, and we have a healthy respect for the emotional roller coaster. So now, let's get to the good stuff, the how, the actual playbook you can use. And you know what? The playbook is actually way simpler than you probably think. Step 1, just be consistent. Invest money you know you won't need for at least 5 or 10 years and keep adding to it on a schedule no matter what the market is doing. That's called dollar cost averaging, and it is incredibly powerful. Step 2, diversify. Seriously, don't put all your eggs in one basket. And step 3, the hardest one for a lot of people, just hold on. Remember, your goal is time in the market, not timing the market. Now, a really handy tool to help you avoid overpaying for stocks is the PE ratio. It sounds complicated, but it's really just a simple number that gives you a quick snapshot of whether a stock is a bargain or, kind of pricey. It literally tells you the price you have to pay to get $1 of a company's profits.
And the source material for this has this brilliant analogy. Think about it like you're buying wallets. So imagine one wallet costs you $50 and it gives you $1 in earnings every year. Now imagine another wallet. It also gives you $1 in earnings, but it only costs you $20. I mean, which one are you going to buy? The cheaper one, right? Every time. That, in a nutshell, is the heart of value investing.
And this brings us full circle, right back to those IT stocks that everyone is buzzing about. A lot of times they have these insanely high PE ratios, which basically means Wall Street is already expecting them to be perfect for years to come. The company is priced for perfection. So even if it does well, the stock might go nowhere. And what happens if they're not perfect? If they just stumble a little bit? Well, we saw what happened to the Nifty 50.
Okay, so if the secret isn't finding the next big thing, and it's not about being a genius market timer, then what is it? What's your ultimate advantage as an individual investor?
It's this right here. Your superpower isn't your brain power. It's not some fancy algorithm. It is your temperament. It's having the guts and the discipline to stick with your plan month after month, year after year, through the good times and the bad. And it's having the patience to let the magic of compounding work over decades, not just days. And so that really is the final question you've got to ask yourself. Because the market is going to test you. It's going to throw terrifying crashes at you, and it's going to tempt you with euphoric bubbles. Your intelligence gets you to the starting line. It helps you understand all this stuff. But it's your temperament that gets you across the finish line. The question is, are you prepared to pass that test? You know that dream we all have? The one where we find some financial genius, A real market whisperer who just tells us exactly what to do with our money so we can, I don't know, kick back on a beach and not worry about a thing? It's a really tempting idea, right? But is it actually a smart one?
I mean, is that really how people get rich? Just by handing their money over to someone who's got all the secrets? We're going to really dive into that today. And trust me, the truth is way more complicated and honestly, a lot more interesting than you'd think. This whole thing reminds me of this classic scene from a Woody Allen movie. He's standing in a line and this guy behind him is just going on and on about the work of Marshall McLuhan. Super loud, super confident. Woody, of course, gets annoyed and tells him he's got it all wrong. The guy fires back, "Oh yeah? I teach a course on McLuhan at Columbia." So what does Woody do? He just calmly walks off screen and comes back with the actual Marshall McLuhan. McLuhan looks at the professor and just says, "You know nothing of my work." And then Woody Allen turns straight to the camera and deadpans, "Boy, if life were only like this."
And that's the fantasy, right? To just be able to pull out the expert whenever we need them. But look, I've got some pretty terrible news for you when it comes to finding that perfect stockbroker. It's news you've probably already guessed deep down. For most of us, for the average person, they don't really exist. Or, let's say they do exist, you have almost zero way of figuring out who the real genius is before it's too late. Okay, so let's say you find a broker with a killer track record. How can you be sure it's actual skill and not just, I don't know, pure dumb luck? It's harder than you think. Let's do a quick thought experiment to show you what I mean. All right, picture this. We've got a big room with 256 people. The game is simple. Everyone flips a coin, and the goal is to get heads. So after the first flip, what happens? Well, statistically, about half of them, that's 128 people, will get heads. We kick out the rest. Now they flip again. Half of them get heads again. So now we're down to 64 people. They flip again. Now we've got 32, then 16, then 8.
And you keep doing this, right? Until after 8 flips in a row, the simple laws of probability tell us we'll be left with just one person standing. One single person who managed to flip heads 8 straight times.
Now, you'd look at that one person and think, wow, what talent, what a genius. But it's nonsense. It's not talent at all. They're not a genius. They are just the inevitable outcome of a probability formula. And here's the kicker. This is exactly how it works in the stock market. If you start with 256 money managers, after 8 years, it's statistically likely that one of them will have beaten the market every single one of those years just by pure chance. And you know what? That person will get famous. They'll attract billions of dollars, but it could just be the luck of the coin flip.
So if beating the market is that hard, even for the pros, we've got to ask a totally different question. When you make a trade with your broker, who is the one person who is guaranteed to make money on that deal? And this gets us to the heart of the problem, a massive conflict of interest. Look, your broker is a salesperson. At the end of the day, their job is to make sales, to generate commissions so they can feed their family. Nothing wrong with that. But your goal is to grow your wealth nice and steady over the long term. And you got to understand, those two goals, they are not always the same thing. You know, there's an old Wall Street joke that just perfectly sums this up. It goes like this. Well, the broker made money, and the firm made money, and hey, 2 out of 3 ain't bad. It's cynical for sure, but man, does it hit the nail on the head about where you, the client, can sometimes end up. But look, this isn't just about some cynical joke. There's some serious academic firepower behind this idea. A really powerful theory that explains exactly why it's so incredibly difficult for even the smartest people on the planet to consistently beat the market. It's called the random walk theory. And here's the simple version. The stock market is insanely efficient. What that means is that any piece of public information, good news, bad news, anything, gets baked into a stock's price almost instantly. So that hot tip your broker just called you with, sorry, but by the time you hear it, it's already old news. The price has already moved. You're too late to the party. This leads to one of my favorite stories in all of finance. It's just wild. Back in 1967, the editors at Forbes magazine literally threw darts at the stock pages of the newspaper to pick stocks for a portfolio. Total random chance. So what happened? 15 years later, that portfolio picked by darts was up 239%. The overall market, the S&P 500, it was only up 35% in that same time. And get this, a whole bunch of professional, high-paid money managers did even worse than the market. Darts beat the pros. It's incredible. Now hold on. The point here isn't that the pros are dumb. They're absolutely not. They are brilliant people. The real problem is something much simpler. The market average, the benchmark they're all trying to beat,
doesn't have to pay any fees. It doesn't pay commissions or advisory fees. All those costs that active managers have, they act like a giant anchor, dragging down their performance year after year.
Okay, so if trying to be smarter than the entire market is basically a loser's game for most of us, what's the winning strategy? What should we do? Well, the answer is actually really simple. You focus on the one and only thing in this whole equation that you can actually control.
And what is that one thing? It's cost. You minimize your costs. That's it. That is the single most powerful lever you have as an investor. Trying to pick the one fund that's going to be a superstar next year is nearly impossible, but picking a fund with super low costs, that's easy. You can do that right now.
Let's use an analogy to make this crystal clear. Think about investing like a horse race. So first up, we have the market itself. That's like a horse with no jockey at all. It weighs nothing. It's just the pure performance of the market. Then you've got a low-cost index fund. That's a horse carrying a really light jockey, maybe 18 pounds. But then you have the typical actively managed fund. That horse is carrying a super heavy jockey, like 150 pounds or more, because of all the high fees and trading costs. Now, over a long race, which horse are you going to bet on? The one with no weight, the one with a little weight, or the one carrying a heavy weight?
Okay, so does all this mean the market is always perfectly efficient? That there are never any mistakes? Well, not quite. And this is where the story takes a really fascinating turn. Check this out. A while back, there was this absolutely bizarre situation with Blockbuster stock. The company had two different types of shares, Class A and Class B. They were identical in terms of their claim on the company's profits. But here's the weird part. The Class B shares, which were way cheaper, actually had 2 votes per share. The Class A shares, which were way more expensive, only had 1 vote. It makes absolutely no sense, right? The shares with more power and the same economic value were selling for a huge discount. It was completely irrational.
And that little story is the perfect proof that the market is not always perfect. These weird, glaring mistakes, they do happen. But here's the catch, and it's a big one. Finding them is the real problem. It takes an unbelievable amount of time, deep expertise, and just painful, grinding research that, let's be honest, most of us just don't have the time or the skill to do.
And that brings us to our final and maybe most important takeaway. It comes from Michael Steinhardt, a legendary hedge fund manager. Someone once asked him what the single most important thing an amateur investor could learn from him was. His answer? That I'm their competition. So just think about that. When you try to outsmart the market, you're not just playing against the odds. You are stepping into the ring with people like Michael Steinhardt, people who live and breathe this stuff 18 hours a day. So the question you really need to ask yourself is, are you sure that's a fight you want to pick?
Welcome to The Explainer. You ever feel like Wall Street is speaking a completely different language? Yeah, you are not alone. Today, we're going to cut right through all that noise. With author Andrew Tobias as our guide, we're going to demystify some of the most confusing and, frankly, misleading ideas in the world of investing. So, let's dive in.
You know this quote from Blackie Sherrod? It just nails it. It perfectly sets the stage for what we're talking about. In the world of finance, where do you draw that line between a smart, calculated risk and just a pure gamble? That's the line we're going to explore today.
All right, first up, let's tackle one of the biggest and most persistent myths in investing. This idea that you can get ahead with some kind of secret knowledge.
Okay, so picture this. You're at a party and someone leans in with a hot tip on some stock that's about to go to the moon. What do? Well, according to our source, you do absolutely nothing. In fact, if the tip turns out to be wrong, just look a little disappointed the next time you see them. They'll probably feel so bad they'll buy you lunch.
And this is where we need to get really, really clear on something. A hot tip? That's just gossip, right? It's chatter. But inside information? That's different. That's specific, non-public knowledge. And using it isn't just a bad idea, it's flat out illegal. And besides, for 99.9% of us, it's something we'll never, ever have access to anyway.
Okay, so if secret tips are a no-go, then what about trying to predict the future by, reading charts and finding patterns? This whole world is called technical analysis. I mean, people literally spend their entire lives staring at charts just like this one, trying to spot trends. You hear all these weird terms like head and shoulders patterns or double bottoms. The whole idea is that the market's past movements hold some kind of secret key to its future. But do they really?
So, what's the short answer? It's a big no.
As our source points out, rigorous academic testing has shown, again and again, that the core idea behind charting is just, well, false. The market's past prices can't reliably predict its future prices, any more than knowing a coin landed on heads can help you predict the next flip.
Next up, let's shift gears and talk about some financial sleight of hand, a maneuver that creates a ton of buzz but is often completely misunderstood: the stock split.
You know, Wall Street just loves a good stock split. A company announces one, and suddenly it's all anyone can talk about. It feels like the company just waves a magic wand and poof, you suddenly have more shares than you did just a minute ago.
So let's break it down with some simple math. Let's say you own 200 shares of a company, and each share is trading at $40. Your total investment then is worth $8,000. Simple enough, right?
Then the company announces a 2-for-1 split. Now look, you've got 400 shares, but the price of each one just got cut in half, down to $20. So your total investment is, you guessed it, still exactly $8,000. Nothing has actually changed.
So here's the bottom line, the thing you absolutely have to remember. A stock split changes nothing about the real value of what you own. It is literally the financial equivalent of trading a dollar bill for two 50-cent pieces. It might feel different in your pocket, but it's not.
All right, buckle up, because now we're walking into the part of the market that acts less like a business and, well, a whole lot more like a casino. First up, options. So Andrew Tobias shares this wild story from his own life. It's back in January 1976. The stock market is going crazy, and he's thinking, hey, Merrill Lynch, the brokerage firm, they're got to be making a killing. So he makes this tiny speculative bet, just $375 on some options.
And just look at this timeline. It shows you just how crazy fast the options market can move. I mean, he buys in early January, and by the middle of the month, the price is quadrupled, and he's already selling some. The value of his tiny bet just exploded in a matter of weeks.
So what was his profit at the end of the day? After commissions, almost $2,400. He turned $375 into nearly $2,400 in about a month. Wow. You can see the appeal, right? It feels just like hitting the jackpot.
But, and this is a huge but, here comes the reality check. The author is the first to admit this was a rare, lucky win. He says that what usually happens with options is that they just expire worthless. For every one thrilling win like his, there are countless small losses. It's a zero-sum game, and that's before you even factor in commissions.
And then there's this other casino game called selling short. This is where you bet a stock's price will actually go down. But man, is it a risky game. See, when you buy a stock, the most you can lose is whatever you invested. But when you short a stock, your potential loss is, theoretically, unlimited. You're fighting the market's natural upward trend. And as one investor in the book found out the hard way, a short bet that goes wrong can be absolutely catastrophic.
All of this stuff, this high-stakes betting, it all points to one of the most powerful and, most dangerous forces in all of finance: leverage.
So leverage, it's really just a fancy word for using borrowed money, and it's incredibly powerful. Just look at this home buying example. You put $20,000 down on a $100,000 house. It goes up in value to $140K. Your $20K investment just made you a $40K profit. That is a 200% return. Amazing! But, and it's a huge but, leverage is a double-edged sword. If that same house drops in value and you have to sell for $80K, poof, you lose your entire $20,000. A 20% drop in the house price caused a 100% loss of your investment.
Now, in the stock market, the way you get this leverage is through something called a margin account. It's basically a loan from your broker to buy more stock. And the advice from our source on using margin, it's incredibly simple. Just don't. Why? Because it preys on our fear of missing out, and it makes it way, way too easy to get wiped out by even a small dip in the market.
Okay, so we've been through hot tips, we've looked at charts, we've walked through the casino. What's the big takeaway from all this? It's that being a savvy, successful, long-term investor isn't just about picking winners. It's just as much about knowing which parts of the market to ignore completely, which games are, frankly, designed for you to lose.
And that really leaves us with one last really important question to chew on. If all these complex tips and charts and products are a losing game for the average person, then who are they actually designed for? Who's really winning here? Something to think about. Thanks for joining us for this explainer.
Okay, let's talk about family finances. I know, the topic can feel a little complicated, but really, at its heart, it's just about one thing:
taking care of the people you love. So we're going to dive right in. Because getting this right, it isn't just about the numbers on a page. It's about building real security for the people who matter most to you.
And hey, let's be real. Sometimes it feels exactly like this, right? This line from a New Yorker cartoon just perfectly captures the messy reality of trying to manage money. So it's totally okay if things aren't perfect. This isn't about being judged. It's about finding a few simple but really powerful ways to move forward.
So where does financial wisdom even begin? Well, it starts with our kids. You know, the greatest gift you can possibly give them isn't just money itself, but the wisdom to actually manage it. And, believe it or not, it can all start with something as simple and as fun as a cookie jar.
The very first lesson is about what some people have called one of the most important secrets in the entire universe. It's this massive force that pretty much determines whether people become rich or poor. And that force is compound interest. It sounds complicated, but it's not. And we're going to break it down with a super simple game.
The game kicks off right here. You tell your kid, okay, we're going to put one single dollar bill in this cookie jar. And from now on, this jar is our bank. The setup is literally that simple.
All right, now this is where the magic really starts to happen. Instead of waiting a whole year for interest like a real bank, you're going to pay them 10% every single day. So on night one, with that dollar in the jar, you add a dime. The next night, well, there's a $1.10 in there, so you add 11 cents. They can physically see their money growing right before their eyes. And get this, here is the incredible payoff. After just 2 months of this daily 10% interest, that single dollar bill has exploded into over $300. For a kid, seeing that happen, it makes the idea of saving feel, well, real, and honestly, pretty darn exciting.
Okay, so now they get how money can grow. Awesome. But now for the next crucial lesson, delayed gratification. What happens when you introduce just a little bit of temptation? Let's say a bag of Reese's Pieces.
The impact of this one tiny decision is just staggering. The kid who waited just 3 days to start the game ends up with a full $304. The one who took the candy, just $228. Think about that for a second. That one little bag of candy ended up costing them $76. The lesson is crystal clear. Starting early makes a huge difference.
So the whole point here is to show them both sides of the coin. Earning interest feels absolutely amazing, right? But what about paying it? You can run the game again, but this time you're charging them 20% interest. You know, kind of like a credit card. Then you just ask them, which would you rather be? The person earning this or the person paying this? I promise you that's a lesson they are not going to forget. Okay, so let's fast forward a bit to the next stage of life. Now we're talking about protecting your partner. Once your lives and your finances start to get intertwined, you absolutely need a legal blueprint to make sure you're both safe, no matter what might happen down the road.
Now this is a critical question because the answer is a lot. When you get legally married, you automatically get over 1,100 legal benefits and protections from the government. But if you're not married, you get none of them by default. It means you have to build that safety net for each other piece by piece. So how do you actually build that safety net? You do it with these. These are the essential documents that make up your legal first aid kit. A will says where your stuff goes. A healthcare proxy lets your partner make medical decisions if you can't. A power of attorney covers the financial side of things. Each one of these closes a really dangerous legal gap.
All right, our next section. I know it can feel a little morbid to talk about, but trust me, planning your estate isn't really about death. It's about your final act of care for your family. It's about making a really difficult time as smooth and as easy for them as you possibly can.
The number one thing you want to save your family from is this word right here, probate. It's the whole court process for settling an estate, and it has this nasty reputation for being expensive, incredibly slow, and just emotionally draining. For example, Marilyn Monroe's estate, it took 18 years to finally get settled.
But here's the really good news. You can skip probate completely. And honestly, it's way easier than you might think. For free, you can add pay on death or transfer on death to your bank and investment accounts. Make sure your beneficiaries on retirement accounts and insurance are all up to date. And for big things like a house, a living trust lets it pass directly to your family, no court required.
And really, this quote gets right to the heart of why all this planning is so important. As the old saying goes, there are no luggage racks on a hearse. You just can't take it with you. So making these plans is simply you deciding where your life's work is going to go, instead of leaving it all up to a judge.
And now we come full circle.
We started this journey talking about taking care of our children, and for many of us, that journey ends with us taking care of our aging parents. This stage, well, it brings its own unique financial and emotional challenges.
You know, our source material mentions a bumper sticker that says, "Get revenge, live long enough to be a problem for your children." It's a funny line, for sure, but there's a really profound truth in there. If your parents need you, it means they're still here, and being in a position to help them, that's a true privilege.
But to really help them in the best way possible, you've got to have some tough conversations before there's a crisis. And hey, do these look familiar? The living will, the power of attorney, the healthcare proxy, they're the same documents we talked about for partners. They are just as crucial for your parents. Knowing their wishes and where their documents are can prevent so much heartache later on.
So when you step back and look at everything, from that cookie jar game with your kids all the way to those tough but necessary talks with your parents, what's the one thing that ties it all together? It's this. Planning ahead isn't about spreadsheets or legal forms. It is truly one of the greatest gifts of love and security you can ever give to your family. So I'll just leave you with this one last question. After everything we've gone over today, from teaching a kid about saving to making sure a parent's wishes are honored, what's the one conversation you can start this week to give that amazing gift to your own family?
All right, let's talk about money, but not in that complicated jargon-filled way. Today, we're diving into a simple path to financial peace of mind. We're going to cover two big things. First, what to do if you ever hit the jackpot and get a sudden windfall of cash. And second, and maybe more importantly, how the rest of us can build wealth slowly and steadily. This isn't about some get-rich-quick scheme. It's about learning to manage your money so you can stop worrying about it and actually start living your life.
So let's just start with a fun little thought experiment. What would you do if $1 million just landed in your bank account tomorrow? It's a great fantasy, right? You're probably thinking new house, quitting the job, traveling the world. But you know, the reality of coming into a huge sum of money like that can be, well, a lot more complicated and honestly way more stressful than you'd ever imagine.
I mean, listen to this. That is probably not the reaction you were picturing. This comes from Gail Sheehy, who became a best-selling author after her book Passages just exploded in popularity. You'd think she'd be on top of the world, right? But she found that all that new money brought on this huge wave of anxiety. And believe it or not, her experience is actually pretty common for people who suddenly get rich. So here's the real kicker. The biggest challenge of a sudden windfall isn't figuring out which stocks to pick. It's dealing with the psychological weight of it all. All of a sudden, you're looking over your shoulder, worried about friends and family asking for money or strangers trying to scam you. And you can't even talk about it. I mean, who's going to sympathize with a new millionaire? The real question becomes, how do you handle it without letting it completely ruin your life? Okay, the good news is there's a simple, straightforward plan you can follow to manage a windfall without all that stress. And I want to be clear, this is not a plan for squeezing every last drop of profit out of the market. It's a plan designed for peace of mind. Think of it as your blueprint for a worry-free financial future. This 7-step plan you see here is all about keeping it simple. Step 1, go celebrate, but don't go nuts. Then the next few steps are about building a safety net, covering your living expenses for years with super safe investments. After that, you put the rest to work for long-term growth in a really diversified, hands-off kind of way. And then, the most important part, you set it and you forget it, so you can actually get on with your life. And that's really the entire philosophy behind this. The goal here is security. It's not to turn you into some day trader who's glued to their screen all day. You know, the greatest luxury a ton of money can buy is the freedom to not have to think about money. And this plan, well, it's designed to give you exactly that. Okay, so that's the plan if you win the lottery. But what about the rest of us? You know, the people building wealth slowly, paycheck by paycheck. How do we find that same peace of mind? Well, that's exactly what we're going to get into next. I love this quote from the Nobel Prize-winning economist Paul Samuelson. What he's saying is, for most of us, the best way to invest is to just give up on that fantasy of hitting it big on one single stock. Instead, you focus on building wealth slowly and surely with simple tools like mutual funds. Yeah, it might not be as thrilling, but it's a whole lot more likely to get you to a comfortable, worry-free retirement. And you'll sleep a lot better at night. And mutual funds are just a fantastic option for the everyday person, precisely because they make everything so simple. I mean, look at this. You get instant diversification across tons of companies. You can set it up to invest automatically right from your checking account. It makes retirement accounts super easy. And you can own a piece of the entire global economy. They basically solve all the biggest problems that stop people from getting started in the first place. Okay, so now you know why mutual funds can be such a game changer. Let's talk about how to actually pick the right ones. It can feel like there are a million different choices out there, but honestly, it all boils down to just a few really simple rules. Rule number 1 is the easiest decision you will ever have to make in investing. Always, always, always choose a no-load fund. A load is just a fancy word for a sales commission that you pay right up front. It can be 3, 4, even 5% of your money, gone before it even gets invested. There's absolutely no reason to pay that when there are thousands of fantastic no-load funds out there. Okay, rule number 2, keep your expenses low. You want to find funds that charge less than 1% a year in total fees. Now, that might not sound like a lot, but trust me, it makes a huge difference over time. Think about it. On a $100,000 investment, a 1% fee costs you $1,000 a year. But a fund charging just 0.1%, that's only $100. That's $900 that stays in your pocket, working for you year after year after year. Now, let's just quickly run through the main types of funds so we're all on the same page. A standard mutual fund is kind of like a big basket holding tons of different stocks and bonds. When you buy just one share of that fund, you're actually buying a tiny little piece of everything inside the basket. It is the simplest way to get diversified fast. Next up, you've got closed-end funds. These are a little different. They have a fixed number of shares that trade on a stock exchange, just like a regular stock. And because of simple supply and demand, sometimes the share price can actually be lower than the value of all the assets inside the fund. It's kind of like finding a way to buy $1 worth of stuff for only 85 cents. And finally, we've got exchange-traded funds. You probably know them as ETFs. You can think of an ETF as a mutual fund that you can buy and sell all day long, just like a stock. But their real killer feature, they are famous for having incredibly low expense fees, which, as we just talked about, can save you a ton of money in the long run. So, how do you choose? Well, this table kind of breaks it down. If you just want maximum simplicity and to set up automatic investing and forget it, traditional mutual funds are a great way to go. If you're a bit of a bargain hunter and you don't mind some extra complexity, you could check out closed-end funds. And if your absolute number one priority is keeping your costs as low as humanly possible, ETFs are probably the best bet for you. Now, look, if you're listening to all of this and your head is spinning and you're feeling a little overwhelmed by the choices, I get it. Here's the ultimate simple solution. Just buy a low-cost, broad market index fund. That's it. This is a fund that doesn't try to be clever. It just tries to match a major market index, like the S&P 500. You're basically just betting on the success of the entire economy. And the evidence is overwhelming. Over the long run, this dead simple strategy will beat the vast majority of those highly paid professional money managers who are trying so hard to beat the market. So, we've covered the how of investing your money. But now let's talk about something maybe even more important, the why. Because the whole point of all of this isn't just to pile up more money. It's to use that money to build a better life. This is from a short story by D.H. Lawrence, and it's just so powerful. In the story, a family is just haunted by this constant, desperate need for more money, no matter how much they actually have. It's this perfect illustration of that nagging feeling that enough will never really be enough. And this leads us to a really common trap. It's sometimes called lifestyle inflation. It's what happens when your spending just automatically rises to meet whatever your income is. You get a raise, so you get a bigger apartment. You get a bonus, so you lease a fancier car. And before you know it, you're making more money than you ever have before, but you still feel just as broke, just as squeezed as you always did. The finish line for enough just keeps moving farther away. I think this quote from the anthropologist Marshall Solins just nails it. He's saying there are basically two ways to feel wealthy. One, you can work yourself to the bone, producing more and more to try and satisfy your endless wants. Or you can take what he calls the Zen road to affluence and simply learn to want less. So the key takeaway is that true financial well-being often has less to do with the exact number in your bank account and more to do with which direction you're headed. That feeling of making steady progress, of saving just a little bit more this year than you did last year, that can bring you way more satisfaction than a big splurge. Because let's be honest, once a luxury becomes a habit, it stops feeling like a luxury. It just becomes another necessity. So, to wrap it all up, the secret to financial peace is to have a simple plan and stick to it. Whether you're managing a huge windfall or just your monthly savings, keep your strategy simple, keep your costs low, and keep your goals clear. And that really brings us to the final question I want to leave you with. Are you just building wealth for the sake of it, or are you using that wealth as a tool to build the life you truly want?
Hello and welcome. Today we're going to unravel a really fascinating financial puzzle. Get this. How can buying wine in bulk, something so simple, lead to an absolutely unbelievable financial return? It sounds kind of crazy, I know, but trust me, when you see the math, it is wild. And this is the number, 177%. That's the annualized rate of return we're going to break down. And no, this has nothing to do with stocks or crypto or some risky new investment. It all starts with a simple discount at your neighborhood store.
So, the big question is, how on earth is that possible? I mean, a 10% discount is, well, it's just 10%. The secret isn't in the discount itself. The magic is in how you think about the money and when you get those savings back. So, let's dive in.
Okay, to understand how we get all the way up to 177%, we've actually got to go back in time to 1978. This is when the first, simpler version of this idea was pitched, and it came up with a return of around 40%. So here's the setup. It's super simple. Picture this. You like wine, and you buy one $10 bottle every single week. Your local shop has a deal. Buy a whole case of 12, and you'll get 10% off the total price. So by buying that case, you've basically just prepaid for the next 3 months of wine, and you've locked in that discount right up front. Now here's the first key insight. You don't get that 10% return over a full year. You get it in just 12 weeks. And since you can do that 4 times a year, it's not a 10% return, it's a 40% annualized return. Now 40% is already fantastic, right? But it turns out that's not even the right number. It's way higher. You see, that 40% figure was really just scratching the surface. If you take a closer look and, more importantly, correctly define what your investment actually is, the return jumps up to 53%.
Okay, this is probably the most important part to get your head around. Your investment isn't the total cost of the case. No, it's the extra money you had to spend today that you wouldn't have spent otherwise. So, instead of spending your usual $10, you spend $108. That extra $98, that is your investment.
So let's look at the new math. You invest that extra $98. In return, you save $1 every week on the wine you were going to buy anyway. Over a year, that's $52 in savings. So you made $52 on a $98 investment. That, my friends, is a 53% annual return. We are definitely getting warmer.
But here's the real kicker. This is where the numbers go from impressive to, well, just plain wild. The thing is, you don't actually have that full $98 tied up for the whole year. Not even close. You start getting it back right away.
The best way to think about this is to stop calling it an investment. Instead, think of it as a temporary $98 line of credit that you gave to yourself. You borrowed from your own pocket to buy the case, and then you immediately start paying yourself back. Let's just follow the money. Week 0, you're out the full $98. But then week 1 rolls around, you don't need to buy a bottle of wine, right? So that's $10 you didn't spend. You've already repaid yourself $10. Now only 88 of your dollars are tied up. And the next week it's 78, you see? The amount of your own money that's actually in use is shrinking every single week. By week 12, you've paid yourself back completely and you're $12 richer.
And that is the secret sauce. Your return isn't based on a fixed $98 investment, it's based on a rapidly shrinking one. Since the average amount of your money in play is way lower than $98, the real rate of return is about to go through the roof.
And that brings us to the grand finale. Now, calculating the true return on this kind of shrinking investment isn't exactly back-of-the-napkin math. So the author of this whole idea turned to a friend with a very powerful calculator.
I just love this quote. It's so perfect. You can just picture it, right? It's the 70s. No Excel spreadsheets. Just a guy and his buddy who's a whiz with a brand new, state-of-the-art Hewlett-Packard calculator. He's basically saying, look, my friend Les crunched the numbers, and this guy is never wrong.
And there it is, 177%. When you properly account for the fact that you're paying back your initial outlay week after week, the true annualized rate of return on your simple decision to buy a case of wine is a mind-blowing 177%. Okay, but let's put this in perspective, because this part is really important. Is this a way to get rich? Absolutely not. You are still only saving $52 a year on wine. It's about the principle.
The rate of return is astronomical, but the dollar amount is small. It's not a get-rich-quick scheme. It's a get-smart-quick scheme.
So what's the real lesson here? Why does this fun little math problem matter? Because it might just point to one of the best and safest investments you can possibly make.
And that is the real takeaway. This was never really about wine. It's about paper towels, it's about coffee, soap, pasta, anything that you buy on a regular basis. Taking advantage of a simple bulk discount on things you know you are going to use is one of the highest yield, lowest risk financial moves available to any of us.
So I will leave you with this one question to think about. As you go about your regular shopping, where are you leaving a 177% return on the table? It's a really powerful way to start rethinking your spending. Thanks so much for joining me.
Welcome back. Today, we're going to cut right through all the noise and answer a question that, honestly, can feel pretty overwhelming. How much life insurance do you actually need? Let's forget all the confusing sales pitches. In just the next few minutes, we're going to build a clear, personalized answer just for you. You know, the source material we're digging into today kicks things off with this brilliant analogy: selling life insurance to young single people. It's like selling ice to an Eskimo. Now, the point isn't that life insurance is a bad thing. Not at all. It's about asking, do you need it right now? If nobody really depends on your income, well, the answer's probably no. And really, this is what it all boils down to. Your need for insurance, it isn't some fixed number. It's a mirror of your life. If you're single, no dependents, you might just need enough to cover final expenses. That's it. But if you have a family that's relying on you and your income, oh yeah, the stakes are much, much higher. Okay, so let's find your number. This is why we're going to ditch those generic rules of thumb. You know, like, oh, just buy 10 times your salary. That's just a guess, right? We're going to build a real number based on your actual life. Ready? Let's do this. So let's get started with the one core principle that just cuts through all the complexity. Life insurance is not about making your family super rich after you're gone. Its real, practical job is to replace your financial contribution. That's it. The source we're looking at just puts it perfectly with this quote. The whole goal is to set things up so that, financially anyway, you will not be missed. I know, it sounds a little blunt, but it cuts right to the heart of why we're even doing this. It's all about providing continuity and security for the people who depend on you. So what does that actually look like? Well, your life insurance policy really has two big jobs to do. First, cover those immediate final expenses, things like medical bills, funeral costs. And second, and this is the big one, it has to replace the income you were bringing in for your family.
Now, here's the thing. You don't have to replace 100% of your take-home pay. I mean, think about it. With you gone, some of your personal expenses just disappear. Your commute, your lunches, your hobbies. The source suggests that your family will probably need about 75 to 85% of your current take-home pay to keep their standard of living.
All right, now we're getting to the heart of it all, calculating your family's income gap. This is the amount of money they'll be short each year without your income. This is the key number we need to find.
We're going to nail this down in 3 simple steps. First, we'll figure out your family's annual income need, using that percentage we just talked about. Second, we're going to subtract any government benefits they might get. And third, we'll multiply that yearly gap to figure out the total lump sum that they're going to need.
Step 1, super straightforward. Just take your annual after-tax income and find about 80% of it. That's your target. And hey, this isn't just for the primary breadwinners. If you're a stay-at-home parent, you need to estimate how much it would cost per year to hire someone to do all the incredible work you do for the family. That's a real economic value. Okay, on to step 2. We subtract any Social Security survivor benefits. Now, the source gives a ballpark figure, maybe around $30,000 a year for a family with young kids. But this can be wildly different for everyone. So this is really important. You've got to go to ssa.gov/estimator and get your own personalized number. Seriously, don't guess on this part. Now, this next part is pretty fascinating. This is how we turn that yearly need into one single lump sum payment. You figured out your annual income gap, right? So now you just decide how long your family will need that support, say until your youngest kid is through college. If that's 20 years, you look at this table and you multiply your annual gap by 15. Now, why 15 and not 20? Because that lump sum will be invested and can grow over time, so you need less upfront to generate that income stream. Pretty cool, huh? Okay, so we've covered the ongoing income. Now, let's tack on those one-time costs. These are the immediate, big expenses that will need to be paid for right away. So to that income replacement number we just calculated, you're going to add money for a few key things. Final expenses, like funeral costs, a general cushion for emergencies. The source recommends at least 25 grand or maybe half a year's salary. Any big nagging debts you want to wipe out. And of course, if you're planning to fund college or other education, that's another big lump sum you'll want to add right here. Okay, so we've built up this pretty big number. But wait, the good news is the insurance only needs to cover the gap between what your family needs and what they'll already have. So now we get to start subtracting. This is the fun part. So from that grand total, you're going to subtract all your existing resources. Things like your savings accounts, any stocks or bonds you have. Yep, that includes retirement accounts like your 401k or pensions. And don't forget any group life insurance you might already have from your job. And hey, if you're lucky and have generous family who likely chip in, you can factor that in too. And there we have it. We've figured out the income your family needs, we've added in those one-time costs, and we subtracted the assets they already have on hand. The number you're left with, that is almost your final answer. So after all that math, all that adding and subtracting, what's the very last super simple step to get to your final practical insurance number? The final step? It's the easiest one of all. You just round up to the nearest $50,000. This is just a practical thing, really, since policies are usually sold in those increments, and it gives you a tiny extra cushion. Simple as that. Now, you might have just done all this math and landed on a number that looks, well, huge, maybe even a little bit scary. But before you get sticker shock, let's just add some real-world perspective here. Look, this number is just a snapshot. It's a plan for one specific scenario. But remember all the other possibilities. Your spouse might decide to go back to work, or even get a promotion. They could remarry down the road. Your kids, believe it or not, will eventually grow up and become self-sufficient. And if push came to shove, your family could adjust to a more modest lifestyle. This isn't about covering every single possible outcome forever. So there you have it. A clear, logical way to get to your life insurance number. But as this final thought suggests, the process doesn't really end with a calculation. That number is just a tool. The real question is about your values. What kind of life do you want that number to support for the people you love? Answering that, well, that's the true purpose of this whole exercise. Thanks for joining me.
Let's talk about Social Security. I know, for a lot of us, just hearing those two words brings up, well, a lot of feelings. Confusion, maybe some anxiety, maybe you're even a little ticked off about it. It feels like this giant, unbeatable political monster, right? But what if it's not? What if we could just push all the politics aside for a few minutes and just look at the simple math? Okay, let's do it. Let's dive in and see if we can tame this beast.
So where do we even start? Well, how about with the massive credibility gap? For anyone under, say, 50, the idea of actually getting a Social Security check feels less like a retirement plan and more like, well, science fiction.
I mean, seriously, think about it. If you had to put your own money on it, would you bet on seeing that check? It's a question that gets right to the core of the problem. A lot of people just don't have any faith in the system anymore.
And this isn't just a hunch you have. It's been around for a while. Get this, a poll from way back in 1994 found that more young people believed in UFOs than in getting their Social Security money back. UFOs! People literally thought they had a better shot at seeing a flying saucer than a retirement check from the government. And that feeling, it's only gotten stronger since then. Okay, but here's the twist. Thinking that Social Security is just gonna poof, vanish entirely, that's, frankly, nuts. It's not gonna happen. But that skepticism, that feeling in your gut, it's actually really healthy. It means you aren't just sitting back and counting on the government to fund your golden years, and that is a very, very smart move.
So let's get into the why. Why does everyone think this whole thing is broken? Well, it's not because of some big, shadowy conspiracy or a massive mismanagement. It's just math. It's a simple and honestly pretty predictable math problem.
When Social Security first got rolling, back in the 1930s, the math was an absolute piece of cake. For every one person collecting benefits, you had 40 people paying into the system. 40! With a ratio like that, the program was flush with cash. It was rock solid.
But then, a couple of things happened that kind of mess with that perfect formula. We got a whole lot better at staying alive, and we started having fewer kids. The simple world a system was built for started to change, and fast.
It was kind of a perfect storm of three things. First, medical science is amazing, and people started living way, way longer after they retired. Second, families got smaller, which means fewer workers in the next generation to pay for the last one.
And third, while all this was happening, Congress kept making the benefits more and more generous. So you've got more money going out and fewer people paying in. You can see where this is headed, right? So that super comfy 40-to-1 ratio? Yeah, that's long gone. Today, we're at fewer than 3 workers for every single retiree. The math is getting a lot tighter. And brace yourself, because it's about to get even tighter. As that massive wave of baby boomers fully retires, that number's going to drop to just 2 workers for every person getting a check. This is the crunch. This is the reason for all the headlines and all the anxiety. Okay, I know, that sounds pretty grim, but here is the genuinely good news. We don't have to blow the whole system up and start over. The solution isn't some political bomb. It's just a few small, gradual tweaks to the formula.
This is the big question, isn't it? Nobody wants to see their payroll taxes shoot up even higher. So if we can't just throw more money at the problem, how in the world do we fix it?
The fix really comes down to 3 gradual changes. No big shocks to the system, nothing sudden. Just a few nudges that, when you put them together, make the whole thing solvent for generations.
So tweak number 1 is actually already in motion. The retirement age is already creeping up from 65 to 67. The proposal is to just keep that going, super gradually, like by a month or so each year, until it eventually hits age 70, decades and decades from now. This gives everyone plenty of time to adjust their plans.
Next up, we tweak the income cap. You know how you only pay Social Security tax up to a certain income level each year? Well, instead of a big tax hike for everybody, the idea is a tiny 1% tax, but only on the income you make above that ceiling. For high earners, yeah, it's annoying for sure, but it's hardly a deal breaker.
Okay, and the final tweak, this one's the real powerhouse, but it's a little technical, so stick with me. It's all about how we calculate inflation for the benefits people get. Right now, the system uses what's called wage inflation, which tends to be a little higher. The proposal is to switch it to price inflation, the cost of living, how much a gallon of milk costs. It's usually a slightly lower number each year.
And that tiny little difference has a massive impact over time. In fact, listen to this. According to Robert Posen, a former top dog at Fidelity Investments, this one single change could pretty much solve the entire long-term problem all by itself. Wow, it's that powerful.
And that's really it. A slightly later retirement age, a tiny tax on the wealthiest folks, and a small change to a formula. It's not some scary monster. It's just a math problem, and it has a clear, totally manageable solution.
So we figured out this system isn't going to collapse in some kind of UFO-related fireball. But that brings us to what I think is the most important point of this entire explainer.
The system will be there. You can count on it. Politicians know that letting it fail would be political suicide. So you can bet there will be a safety net waiting for you when you retire. It might not grow a lot, but they won't let it shrink dramatically either.
But here's the absolute key. Even in a perfectly funded system, that check was never designed to pay for your dream retirement. It wasn't meant to cover your vacations, or your hobbies, or your grandkids' college funds. It was never supposed to be the whole plan.
Its purpose, from day one, has always been to provide a basic floor, a foundation to keep seniors out of poverty. Think of it as a safety net, not a featherbed.
Remember that healthy skepticism we talked about at the beginning? This is where it pays off big time. Your real, comfortable, have fun in the sun retirement is going to come from the things you control. Your own investments, your Roth IRA, your savings. That's the safety net that matters most.
So we've seen the problem isn't as scary as it looks, and the fixes are actually pretty straightforward. The real question isn't whether the system has a plan to survive. The question is, what's your plan to thrive?
All right, let's talk about 2 topics that are, usually a recipe for an instant nap. Taxes and the national debt. But I promise, if you stick with me, we're going to look at all this from an angle that might just flip the way you think about our entire economy. You remember this rule from Monopoly, right? It's kind of funny. Sounds totally made up. But what if? What if the way we're supposed to run a real country's economy is just as weird and counterintuitive? What if some of our biggest money problems aren't really about money at all, but about how we think? So yeah, that's the big question we're diving into here. We are going to challenge some of the most common ideas out there about how government money works. And it all starts with this really fascinating story from back in the 1970s. Okay, so picture this. The year is 1974. The country is absolutely reeling from an oil crisis. A young writer, barely in his 20s, somehow lands an interview with the Secretary of the Treasury, Bill Simon, a guy who was known for being let's just say, pretty intimidating. And right at the end of the interview, the writer decides to throw out this crazy idea. The logic behind it was actually super simple. Why are we taxing things we want more of, like work and investment? Why not tax something we want less of, like burning a ton of gasoline, and then give all that money right back to people by cutting their income tax? So how did the Treasury Secretary respond? That was his answer. Not that it was a bad idea, not that the math was wrong. He said, basically, yeah, duh, we should do that, but good luck getting it passed. The assumption was that in a democracy, people would never accept a small tax hike on gas, even if it meant they got a bigger tax cut somewhere else. It was a great idea, completely shut down by politics. And this, right here, this is the key. It perfectly shows a massive point that we almost always forget about taxes. They are not just about collecting money for the government to spend. No, they are one of the most powerful tools we have to guide and shape how millions of people behave. You could call it strategic taxation. It's about being really smart about what you're taxing. Instead of just taxing income, which, hey, we all want more of, you can put taxes on things we actually want to reduce, like pollution or our dependence on foreign oil. And the way the specific plan was designed was it was brilliant. First, you announce it 5 years ahead of time, so nobody gets surprised. Car companies have time to adapt, people have time to plan. Second, you write it into the law that every single penny collected goes right back to the taxpayers in the form of a lower income tax. And maybe the best part? It's basically a voluntary tax. Don't want to pay it? All you have to do is buy a car that gets better gas mileage. I mean, just stop and think about what could have happened. America could have become the world leader in making fuel-efficient cars. We could have saved literally trillions of dollars that we ended up sending overseas to buy oil. We could have been a stronger, wealthier country. And all of that was on the table, just by changing what we decided to tax. Now, this kind of short-term thinking in politics, it has real long-term consequences. And maybe the biggest one is the national debt. You hear the numbers all the time, trillions and trillions of dollars. They're designed to sound absolutely terrifying. But let's take a second and actually break down what that number really means. So as of right now, if you were to divide the national debt up evenly, it would come out to about $60,000 for you, for your partner, for each of your kids, for every single person. That feels crushing, right? It feels like this impossible weight we can never get out from under. But what if I told you that is completely the wrong way to look at it? Because here's the thing about that huge, scary number. On its own, it's pretty much meaningless. To actually understand debt, any debt, you need context. You have to compare the size of the debt to the size of the whole economy, what economists call the GDP, or gross domestic product. Let me put it this way. Imagine a billionaire with a $175,000 mortgage. Now imagine a nurse with the exact same $175,000 mortgage. Who's in more trouble? Well, it's the nurse, obviously. For the billionaire, that debt is pocket change. For the nurse, it might be overwhelming. The debt is the same, but the context, the size of their income, is completely different. And that exact same logic applies to our country. And this brings us to probably the single most important, most mind-blowing takeaway about the national debt. The goal is not to pay it all off. We don't have to get it down to zero. I mean, successful companies carry debt all the time. Healthy countries do too. It's not about eliminating it. It's about managing it correctly. So here's the rule of thumb. As long as our economy, our GDP, is growing faster than our debt is, the debt is actually shrinking relative to our ability to pay for it. It gets easier and easier to handle, just like that billionaire's mortgage. And believe it or not, we have a fantastic track record of doing exactly this. So let's jump in the time machine for a second, because we have already solved this exact problem before. After the single biggest spending event in all of human history, World War II, the United States was left with a mountain of debt that was just colossal. So what did we do? Just look at these numbers. In 1946, our national debt was 121% of our entire GDP. It was bigger than our whole economy. But then, over the next 35 years, we drove that number all the way down to just 30%. I mean, that is an absolutely incredible economic success story. So how on earth did we pull that off? Did we run massive budget surpluses and pay it all back with extreme austerity? Nope, not at all. We simply grew our economy so fast and so consistently for so long that the debt just became a smaller and smaller piece of the pie. We didn't pay down the problem, we outgrew it. And you know, it's also kind of fascinating to look at what tax rates were during this exact period, when we were shrinking the debt so effectively. The top marginal tax rates were, well, they were way higher than they are today. The source points out that under President Eisenhower, a Republican, the top rate was 90%. President Kennedy, a Democrat, cut it down to 70%, and it stayed high for years. So if we know that smart, strategic taxation can help solve huge problems, and we know that the key to managing debt is just growing the economy, why don't we just do it? Well, it all comes down to two very different competing ideas about what the government should do with its money. As the source material lays it out, you basically have two camps. On one hand, you've got the pay-as-you-go philosophy, or pay-go. This basically says any new spending has to be paid for, either with cuts somewhere else or with new taxes. This is the approach that led to those budget surpluses back in the late 90s. Then, on the other hand, you have the philosophy that says any extra money, any surplus, belongs to the people, and the government should immediately give it back in the form of tax cut. And the source really highlights how this plays out in the real world. You had President Clinton arguing that we should use the budget surplus to save Social Security first, basically to get our national finances in order for the long haul. The next administration, under President Bush, argued that the surplus wasn't the government's money to save, and it should be returned to the taxpayers. And these aren't just little accounting arguments. They're really deep, fundamental disagreements about the whole purpose of government. And that brings us right back around to the big, powerful question posed in the material we've been looking at. From a simple, common-sense idea like a gas tax swap to a proven, historical strategy for managing the national debt, it often feels like the obvious solutions are staring us right in the face. So the question is, what does it say about our democracy that doing the obvious thing so often seems to be the hardest thing to do? That's definitely something to think about. Thanks for joining me on this one.
Let's be honest, forget deep market analysis for a minute. Today, we are talking about the art of conversation. We're about to arm you with a very specific, and I mean very useful set of tools. Think of it as your secret playbook for how to sound incredibly smart about finance at your next party.
You know that exact moment, don't you? You're just trying to enjoy a drink, make some small talk, and then bam! Someone turns to you and asks, "So, what are you into these days?" And you know they're not talking about your Netflix queue. Your mind just goes completely blank. The pressure is on.
Well, here's the secret. You are not alone. And the key thing to realize is that this isn't a test. Financial small talk is really just a performance. And like any good actor about to go on stage, you just need a script. And lucky for you, we've got some killer lines ready to go.
Now, this isn't stuff we just made up. This comes straight from Andrew Tobias's classic guide, which is basically the perfect playbook for cocktail party confidence. These aren't just lines, they're tactical social maneuvers.
Okay, first up, let's talk about the most direct approach, the art of the bluff. This is for when you want to sound like you are fully invested and know exactly what's going on, even if, you don't.
Memorize this one. This is your all-purpose golden ticket phrase. It's so simple, so confident, and it is just packed with implications. You just casually drop this into the conversation, and then sit back and watch what happens.
So why is this little sentence so brilliant? Well, here's the genius of it. It works no matter what's actually happening in the economy. If everyone agrees with you, hey, you sound totally informed. If it's a contrary opinion, you sound like a shrewd, independent thinker. Either way, just having a take on the Fed immediately signals you're in the game. It's a total conversational win-win. But what about the dreaded follow-up question? Someone who thinks they're a little smarter, a little more confrontational, might press you. Oh, really? How could the Fed possibly ease up any further? Don't panic. You have a comeback.
That's it. That's the whole line. Just one word. Helicopters. You say it with a slight, all-knowing smile. It's an absolute conversation stopper, and it makes you sound like you're referencing something incredibly deep and complex.
And here is the fantastic inside joke that you are now officially a part of. Helicopter money was a real concept floated by none other than former Fed Chair Ben Bernanke. So by saying helicopters, you're not even bluffing anymore. You're dropping a legitimate piece of financial trivia. The source material says if they still look confused, you just tell them to Google it. Checkmate.
Okay, but what if you've actually been sitting on the sidelines? I mean, if you're not really in the market, you need a different kind of play. And that brings us to our second amazing strategy, the graceful dodge.
Here we have two absolutely fantastic ways to sidestep the question entirely while still making you look great. On the left, you've got this appeal to sophisticated safety. And on the right, you have the appeal to a higher moral ground. Both are beautiful.
Let's break down the psychology, because this is where the magic really happens. The municipals line subtly implies that you're in such a high tax bracket that only boring old municipal bonds make sense. It inspires pure envy. The family timeline, though, that reframes the entire conversation. All of a sudden, the person asking about stocks seems like this money-grubbing obsessive who's probably neglecting their family. It inspires guilt. See? Incredibly effective.
All right, so let's say you don't want to bluff, and you don't want to dodge. You want to sound wise, philosophical. Or maybe you just need to shut down someone who's bragging a little too much. Welcome, my friends, to the Wise Comeback.
This is just a beautiful line, isn't it? It sounds so profound, it's timeless, and it immediately elevates you above all that day-to-day market noise. It says you're not a gambler, you're a true investor, a student of value.
And the best part? It's not just some nice-sounding thing you made up. You can actually credit it to Charlie Dow himself. And yes, I mean that Dow from Dow Jones. Pointing out that he said this over 100 years ago and it's still true? Well, that just adds a whole other layer of historical weight to your wisdom.
Now for the more, shall we say, pointed comebacks. What do you say to that person who just will not stop boasting about their latest stock pick? Or when you're just plain done with the whole conversation? Don't worry, we've got a line for each of those situations. So on the left, we have a line that is just dripping with smiling cynicism. Suggesting it's time to short their amazing stock is a very polite way of saying you think their little success story is a bubble that's about to pop. And on the right, we have a more obscure but oh so devastating historical insult.
To understand the raw power of that insult, you first need to look at this number. $100 million. That is the fortune that a woman named Hetty Green left behind when she died, all the way back in 1916.
And here's the kicker. Hetty Green, also known as the Witch of Wall Street, was famously incredibly cheap. She was a financial genius, but she was also miserable and pretty much hated by everyone, especially her own family. So when you call someone a regular Hetty Green, you're not just commenting on their money, you're delivering this subtle, really cutting critique of their entire character. Most people won't even get the reference, which honestly just makes it even better.
So, okay, we've gone through bluffs, we've gone through dodges, and some killer comebacks. But let's zoom out for a second. What's the bigger lesson here? I mean, why is this playbook so darn effective?
The real takeaway here isn't just to memorize a few clever lines. It's to finally understand the game that's being played. This kind of talk is almost never about actually sharing useful information. It's about social positioning. It's about signaling how smart you are, how successful you are. It's all a game of status.
And that really is the most important point. Once you realize that all this financial small talk is just a performance, you're no longer an intimidated person stuck in the audience. You're an actor who's just been handed the script. You know the lines, you know what to do, and you can play your part with total confidence.
You now have the tools. You can play the shrewd contrarian, the savvy high earner, the wise philosopher, or the down-to-earth person who has their priorities straight. The next time the conversation turns to money, the choice is totally yours. So, which role are you going to play?
You know, some decisions in investing seem small, but they can have a huge impact on your wallet. Today, we're talking about one of those, choosing a broker. It sounds pretty simple, right? But the difference in fees can be absolutely astronomical. Let's dive in. So we're pulling this story from the author Andrew Tobias, and he kicks things off with a pretty surprising anecdote. He actually dedicated one of his books to his broker, a guy he's used for 40 years. But, you know, that kind of loyalty came at a steep price. And when I say steep, I mean $356 for a single trade. Ouch. So yeah, maybe for sentimental reasons he kept that old broker around. But here's the thing. He moved most of his actual trading somewhere else. And when you see the numbers, you'll get why. His other brokers, places like TD Ameritrade and Fidelity, they charge him just $8 for the same thing. I mean, that's not just a small difference. That is a total game changer. And here's the real kicker. You'd think, okay, you pay less, you probably get worse service, right? But Tobias found it was the exact opposite. He says the savings were just phenomenal, and the service he got from the discount guys was actually more efficient. So you're literally getting a better service for a tiny fraction of the cost. Wild. Okay, so to really hammer this point home, let's look at a real-world example from the author himself. This is where the numbers get, well, they get truly staggering, and it shows you just how much is on the line here. All right, so here's the setup. The author decides to make a pretty big trade. He's buying 100,000 shares of a particular stock. Now, the price per share is actually pretty low, just 31 cents. So the whole investment is about $31,000. So, take a guess. What do you think the commission on a trade like this would be?
And this is the million-dollar question, or in this case, the $2,000 question. Is the fee a percentage? Is it a flat rate? Well, the answer depends entirely on which kind of broker you're using. And believe me, the difference is just mind-blowing.
And here it is, the full-service broker. They would have charged 2 cents per share, which adds up to $2,000 plus a little $6 fee, so the grand total is $2,006. Now, the discount broker? $8, a flat fee of $8, not $800, not $80, just $8. It's almost hard to believe.
And believe it or not, it gets worse. That $2,000 fee, that's just to buy the shares. When you decide to sell them, you'd get hit with another $2,000 fee. So we're talking over $4,000 in total fees for one round-trip trade, a trade that would have cost you $16 at a discount firm. 16 versus 4,000. Let that sink in.
Okay, that example is obviously super dramatic, but it brings up a bigger question. We know that $8 is way, way better than $2,000. But what about $5 versus $8? Or $2 versus $5? Let's try to get some perspective here.
So the good news is you've got tons of great low-cost options out there. The source material points to big names you probably recognize: Fidelity, TD Ameritrade, E-Trade, and then you've got firms like Vanguard, where commissions can be as low as $2 for a trade. So yeah, there's no shortage of cheap options.
But this is where the author brings us back down to earth, to what really matters. He basically asks, beyond a certain point, who really cares? Think about it. On that $31,000 investment we talked about, would saving an extra $3 by paying $5 instead of $8 have made any real, meaningful difference? Nah, of course not. And that's the whole point. Fretting over whether you should pay $2 or $5 or $8 in commission, you're kind of missing the forest for the trees. That isn't the decision that's going to make or break your returns. Which brings us to the final and, honestly, the most important question. If the choice between a $5 broker and an $8 broker isn't the big one, what is? What should you really be asking yourself?
Well, the first really big decision is the one we've been looking at this whole time. Are you going to go the low-fee discount route or the high-fee full-service route? Because, as we saw, that's literally a $2,000 question. That is a decision that matters a lot.
But the author suggests there's an even deeper, more fundamental question you need to ask. One that comes way before you even think about picking a broker. This one gets right to the heart of your whole investment philosophy. And here it is. The ultimate question isn't how you should buy stocks, but if you should be buying individual stocks in the first place. Or, as the author hints, should you be using something like low-cost mutual funds instead? See, that question, the one about your core strategy, is infinitely more important than sweating a $3 difference in commission. And that's the one that's really worth your time.
You know, we're always told that to win at investing, you have to be some kind of Wall Street genius. But what if that's just not true? What if I told you the secret to outperforming the pros was so simple you could set it up in an afternoon and then just get on with your life? Well, let's dive in.
I mean, just let that sink in for a second. This is basically saying that you, right now, with a few clicks, can get better results than the people who are paid millions of dollars to manage money. It sounds almost too good to be true, doesn't it? But stick with me, because that's the core idea we're going to unpack.
All right, so what is this secret weapon? This simple strategy that can supposedly beat the experts at their own game. Let's break down exactly how it works. I think this is a huge fear for so many people, right? The idea that to be a successful investor, you have to be glued to stock tickers and financial news 24/7. Well, we're here to bust that myth. The truth is, that kind of complexity isn't just a waste of time. It's often the very thing that trips people up. Okay, here it is, the elegant, powerful engine behind this whole thing, the index fund. Instead of frantically trying to pick that one magic stock that's going to skyrocket, an index fund does something that's, well, beautifully simple. It just buys all the stocks in a big market index, like the S&P 500. So you're not trying to beat the market, you're just owning a piece of the entire market. Simple as that.
And here's where the genius of this strategy really comes into play. You don't need a dozen complicated funds. It really just boils down to two. Yep, two. Step one, buy a U.S. stock index fund. Boom, you own a piece of the entire American economy.
Step 2, buy an international stock index fund. Now you own a piece of the rest of the world's economy. And just like that, you're a globally diversified investor. It's really that straightforward.
Okay, so a simple theory is great. Love it. But how do you actually do this? Where do you go? Well, in this next part, we're going to meet the folks who made this whole low-cost revolution possible in the first place. So this story, this entire movement of simple investing, it really starts with one guy, John Bogle, the founder of Vanguard. And his mission was totally revolutionary at the time. He basically wanted to build a company that worked for Main Street, not for Wall Street. His whole philosophy was a relentless attack on high fees, because he knew a simple truth: every single dollar you pay in fees is a dollar that's not growing for your future. Just look at that number for a second, 0.2%. That's the average fee Vanguard charges. Now, the industry average is 5 times higher. And that might sound like a tiny difference, but trust me, over decades of investing, that gap compounds into an absolute fortune. A fortune that stays in your pocket, not somebody else's. Of course, when someone has a great idea like Vanguard's, it's not long before others catch on. Competitors like Charles Schwab saw that people were hungry for low-cost investing, and they jumped right in. And that kicked off this amazing price war that has been fantastic news for all of us. It's a race to the bottom on fees, and guess who wins? We do, the regular investor.
So let's get practical. Here's a quick look at how these pioneers stack up for that two-fund strategy we talked about. You can see the specific ticker symbols for the funds you'd use. But for someone just starting out, that minimum line is probably the most important part. Schwab's $100 minimum makes it so incredibly easy to just get started and begin building that crucial habit of investing.
Okay, so the simple path is awesome. We get it. But what if you're the kind of person who thinks, matching the market is cool, but I want to try and beat the market? Well, that brings us to a really fascinating and totally different approach to investing.
For that, we need to talk about a firm called Tweedy Brown. Now, these guys have been around for over 100 years, and their pedigree is just, wow, unmatched. They learned how to invest directly from Benjamin Graham. You know, the guy who literally wrote the book on value investing and just happened to be Warren Buffett's mentor.
No big deal. So what's their secret? Well, their philosophy is pretty simple to understand, but it's really hard to do well. They aren't chasing trends or the hottest new thing. They're basically bargain hunters. They're digging through the stock market, looking for solid, good companies that are on sale for some reason. The goal is simple: buy $1 worth of a company for 50 cents.
And this is what makes them so special. Look, getting higher returns in the market is already really hard. But getting those higher returns with less risk, with less of a roller coaster ride, that's like finding a unicorn. And that last point is so important. The people running the funds have their own money invested right there with you. They have serious skin in the game.
And here's where a strategy like this really earns its keep, when things get ugly. During the financial crisis in '08, when global markets were just in free fall, the Tweedy Brown funds also went down. I mean, nobody's immune. But they fell way, way less than the average. That buffer, that protection on the downside, left their investors in a much, much better spot when the recovery finally kicked in.
So we've got two pretty clear paths, right? The super simple index way and the classic old-fashioned value way. But there are also some interesting options out there that kind of blend these ideas together. Let's take a quick look.
You can think of these as clever twists on the standard index fund. For example, wisdom tree funds say, hey, instead of weighting by size, let's give more weight to companies with strong fundamentals, like earnings. Meanwhile, Guggenheim's RSP fund treats every company in the S&P 500 as an equal, so the little guys have just as much say as the giants. And that MSCI fund, it's designed for people who want to own stocks from all over the world, but with less of the wild roller coaster ride.
So really, when you boil it all down, what we've seen are two incredible but very different philosophies for success. On one side, you have the simple, elegant, ultra-low-cost path of just owning the market. On the other, you have the deep, research-heavy path of true value investing. There's no single right answer here. Both have a long history of making patient investors very happy.
And so, that brings us to the fork in the road. We've laid out the map. We've highlighted two powerful ways to take control of your financial future. The only question left is the one you see right here. So, which path will you explore? It's a pretty powerful position to be in, isn't it? The ability to build your future, and even outperform the pros, is officially in your hands.
All right, let's dive into something that's been called the eighth wonder of the world: compound interest. It's this quiet, invisible force that starts out small, But as you're about to see, it has the power to build incredible wealth from almost nothing. Let's get right into it.
Turning a single dollar into millions? I mean, that sounds like something out of a fairy tale, right? But what if I told you the secret isn't magic, it's just math and it's time? That's the incredible power we're going to unpack today.
So what even is compound interest? Well, put simply, it's when you start earning interest on your interest. The best way to think about it is a tiny snowball at the top of a really long hill. At first, it's nothing, but as it starts rolling, it picks up more snow, getting bigger and faster and bigger and faster. That snowball, that's your money.
Okay, so let's get into the first and maybe the most deceptive part of this whole process. See, the story of compounding doesn't start with the big bang. It starts with a whisper. For a long, long time, it feels like absolutely nothing is happening. And this is where most people get bored and give up, but it's the most critical part to understand.
This table right here is going to be our roadmap for this little journey. Take a look. On the left, you've got the number of years, all the way from 1 to 200. And across the top, you've got different interest rates. Every single number you see shows what happens to just $1 over time. We're going to start by looking at that 8% column to see how this story begins.
Let's imagine you get a pretty solid 8% return. After one full year of waiting, your dollar has grown into $1.08. Yep, you've made 8 pennies. It's pretty hard to get excited about that, isn't it? This is that whisper I was talking about.
Okay, let's jump ahead 5 years. Still at that same 8%, your dollar is now worth $1.47. Just think about that for a second. 5 years have gone by, and you still can't even buy a decent cup of coffee with the profits. At this point, that snowball is barely bigger than a pebble.
And now, we're at the 10-year mark. An entire decade later, you've finally managed to double your dollar. It's now worth $2.16. This is the really deceptive part. For 10 years, the growth feels almost pointless. But if you can just hold on through this phase, the accelerator is about to get slammed to the floor. And here we go. We survived the slow start. Now we get to see what happens when that snowball truly starts to pick up speed. This is where the numbers start to get a little bit crazy.
So we're going to take some huge leaps forward in time now. We'll even switch to a 10% rate of return to really see the effect. We're going to look at what happens at year 50, then year 100, all the way to year 200. You might want to brace yourself.
Our first stop, 50 years. At a 10% return, that same dollar, the one that took a decade just to double, has now exploded to $117. You can really see it now. The growth curve is no longer flat. It's starting to bend sharply upwards. But we're just getting warmed up. Let's double the time again and jump to the 100-year mark. That single dollar is now worth $13,780. It's not just adding anymore, it's multiplying. The money your money is making is now making serious money of its own.
And now for the moment that almost breaks your brain. At 200 years, that one single dollar, left alone at a 10% return, grows to $190 million from $1. No, that's not a typo. That is the astonishing, almost unbelievable power of time.
This chart shows you just how critical that rate of return really is. Look at the difference over 100 years. At 5%, your dollar becomes $132. Not bad. But jump to 10% and it's over 13 grand. And if you could somehow get a 20% return, a staggering $82.8 million. Those seemingly small differences in the rate lead to absolutely astronomical differences in the end.
Okay, so those numbers are just wild. But, before we get carried away planning our 200-year retirement fund, we do need a quick dose of reality. These amazing theoretical numbers come with some very important real-world footnotes.
Yeah, our source material makes this really critical point. It basically reminds us that there are two forces constantly working against our returns: inflation, which is the rising cost of everything, and of course, taxes. Earning even 3 or 4% after you account for those two is a real challenge. So it's really important to get this difference between the dream and the reality. The incredible numbers we just looked at are the gross returns. That's the pure, beautiful math at work. But your real take-home return, the money you can actually spend, is always going to be a little bit lower once you factor in rising prices and the tax man. So what's the big takeaway here? Even with those headwinds of inflation and taxes, the core lesson is still one of the most empowering ideas in all of finance. Let's just boil it down to what really matters. This whole thing really comes down to 3 crucial lessons. First, your most powerful asset isn't how much money you have, it's how much time you have. The earlier you start, the better. Second, the rate of return matters a lot. Small percentage differences now can become millions of dollars later. And finally, you have to have the discipline to get through those slow, boring early years. That's the price of admission for the explosive growth that comes down the road.
And that really brings us to the final thought here. The math of compounding is just undeniable. The power is there for anyone who has the patience to let it do its thing. So the real challenge isn't finding some secret investment, it's recognizing that your greatest asset is simply time. The clock is ticking. So the question is, how will you use it?
All right, let's talk about money. Today, we're going to cut through all that noise surrounding personal finance. We're drawing inspiration from Andrew Tobias's classic guide to boil it all down to one powerful, super straightforward strategy for building wealth.
I mean, have you ever felt just buried under an avalanche of financial advice? You've got stocks, bonds, crypto, options. You've got gurus telling you a million different things. If you have, you are so not alone. It almost feels like it's designed to be complicated, right? But here's the thing, it really, really doesn't have to be. And that's the whole promise from the book we're looking at today. It's all about a simple, clear path that, well, you definitely don't need a PhD in economics to understand it. So let's jump in and see what it's all about. So what is this simple path? Let's be clear, this isn't some get-rich-quick scheme. No. This is more of a get-rich-surely plan. And it's all built on one single, incredibly powerful idea. And here it is. This is it, right from the source. This is the entire blueprint we're going to unpack today. You'll notice there are no complex charts, no confusing jargon. It's just a few simple paragraphs that honestly could completely change your financial future. Okay, so this is the absolute heart of the whole thing. It has nothing to do with timing the market or trying to pick the next big hot stock. The author basically says, look, unless you're going to inherit a fortune, the surest way to become rich is to save everything you can and invest it for long-term growth. Simple as that. That's the foundation for everything else. Now, this is where the math gets really cool. Check this out. If you can just save 10% of each paycheck and then earn a 7% annual return on it, after about 30 years, you'd have a nest egg that's equal to 10 years of your income. Just think about that. At that point, you could pretty much live off the investment returns for the rest of your life. It's an amazing formula. Okay, so let's break this down into steps. Step 1, and this is probably the most important one, is all about building that savings habit. This is the one part you have total control over, and it's where it all has to start. So what's the magic number? It's 10%. Just 10% of every single paycheck. And the author makes a fantastic point here. Think about it. There are people out there making 10% less than you are, and they're getting by just fine. The idea is you can live like them and just invest that difference. So how do you actually do this without it feeling like a huge chore? The key is automation. You take willpower right out of the equation. First thing, contribute to your retirement plan at work, especially if they have a company match. That's literally free money. You have to take it. Then, for everything else, just set up an automatic monthly transfer from your bank to an investment account. Set it and forget it. All right, so once you've got that savings habit down and it's happening automatically, the next step is to put that money to work. This is the growth engine. This is what's going to power you toward that big goal. And the target here is a 7% annual return. Now, this isn't just some number pulled out of thin air. Historically, that's been about the average return for the stock market over really long periods of time. But, and this is a big but, there's a really important catch. That 7%, it has to be your real return. And what does that mean? It's the growth you actually get after you account for taxes and inflation. You know, those two silent killers that are always eating away at your money's buying power. So it's that real return that truly matters in the end. So how in the world do you actually get that return? Well, the author's suggestion is brilliantly simple. Just own the whole market. You do that using low-cost index funds. For example, you could split your investment between a fund that covers the entire US stock market and another that covers the international market. This way, you get super broad diversification for like almost no cost. Okay, so we've got the mechanics down, right? Save 10%, invest it for a 7% real return. Easy enough. But this third step, this one is probably the hardest of all, because it's not about numbers anymore. It's about psychology. It's about learning to play the long game. And I know what you might be thinking right now. Wait, is that it? Really?
And the answer from the book is a loud and clear yes. That's it. The absolute beauty of this whole plan is how simple it is. And this quote just perfectly captures the mindset you need. When the stock market collapses and everyone else is freaking out, this strategy tells you to look at it as a giant sale. It's like your favorite store just put everything on clearance. You're buying the exact same great stuff, just at a huge discount. Every one of those automatic investments you set up is now buying you more for your money. So here's the bottom line. The system itself is incredibly simple, but that doesn't mean it's easy. Not at all. The hardest part, by far, is just having the patience, the discipline to stick with it for decades, through all the market highs and all the scary lows, and not messing with it. Okay, I get it. This all sounds great in theory, but I'm sure you've got some questions popping into your head. So let's do a quick Q&A and tackle a couple of the most common ones with answers straight from the book. First up, the big one. The question everyone wants to ask, right? Can I get rich any faster? Can I speed this up, maybe get 15 or 20% returns and just get there in half the time? Well, the author's answer to this is just pure gold. He says that when you start aiming for those higher returns, it's actually a pretty good way to end up with lower returns. Why? Because chasing those big numbers means taking on way more risk, which usually leads to big mistakes. That simple, steady path, it's the one that's way more reliable in the long run. Okay, here's another really important question. What if you're, say, 63 years old, you're getting close to retirement, and you're thinking, man, have I just missed the boat on this whole 30-year thing? The author is refreshingly direct about this. He basically says, for this specific 30-year plan to work its magic, yeah, it's probably too late. But, and this is key, that doesn't mean this knowledge isn't valuable. In fact, maybe the most powerful thing you can do is to share this simple wisdom with your kids or your grandkids. Give them the kind of head start you might not have had. So let's just wrap this all up. What's the simple path? First, save automatically. Make that 10% happen without even thinking about it. Second, invest that money consistently in those boring, low-cost index funds. Third, and this is the tough one, be patient. Think long-term and ignore all the noise. And remember, the goal here isn't just to hoard a pile of money. It's to build a secure future while still enjoying your life today with the other 90% of your paycheck. Look, this whole thing doesn't start with some giant, scary leap. It just starts with one small step. So I want to leave you with a question to think about. Now that you've seen just how simple this can be, what is the one small thing you can do today, like right now, to start on your own simple path to wealth?